tech is the future. But I think right now we're in an air pocket.
It's important to remember narrative follows price.
Anything that puts a dent on the perfection of the chip stocks will cause a market reaction. The mood is souring a little bit.
The fears of this gyrations in stocks, I think, will not slow down at all.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, facing down a triple threat. Economists looking for a hawkish hold from Fed Chair Kevin Warsh as the latest diplomatic effort between the US and Iran is facing a setback. SK Hynix is kicking off a big day for tech earnings, missing very high expectations. Microsoft and Meta up next.
Operating profit at SK Hynix only up 557%. So that was incredibly disappointing for a lot of people. Look, it's almost funny that we're talking about SK Hynix as some sort of leading indicator from Microsoft and Meta, considering that their shares are up 120% so far this year, even with a 50% drawdown. Meta is down 10% so far this year. Microsoft is down 18% so far this year. So here is the issue. Do they face the same high bar because of concerns about CapEx spending, or are they coming from a weaker place and just have a lower bar to really clear?
Just sit on SK Hynix. Look at that move. Look at that move today off the back of a six-fold surge in quarterly profit, off the back of posting margins of 80% plus. The bar is simply too high for this stock, for Intel, for Samsung. To Bramo's point, Microsoft and Meta, you flatter them. They've been in bear markets, off the highs of more than 20% for much of the last month or so. And to your point, is the bar lower for them? Now, if they put up good numbers later on this afternoon, and people start to freak out about the CapEx number, even though growth elsewhere is decent, and those stocks have been battered over the last few months, then we've got a very different problem in this equity market.
And maybe Max Kettner will no longer be bullish. If you really have this serious pushback to CapEx expectations, you've already seen a bit of pushback when it comes to valuations in credit markets. That will only continue if you see that kind of reaction in equity markets, and speaks to something beyond just positioning.
Let's turn to the commodity market. Check out crude this morning. 3-day slide on Brent. Down something like 15% over that period. This morning a bounce, up by close to 4. Brent crude at 87. WTI 82. 4 days of relative calm. The strikes make a comeback.
Yep, the strikes are back. That calm that we saw since Friday is now over. The United States CENTCOM is talking about these surprise attacks that they intercept in terms of ballistic missiles towards U.S. military installations in the region. And then they fired back alongside, this is Iranian-backed militias in Iraq, alongside Saudi Arabia, which just goes to show that you can potentially see an opening for more Gulf Arab partners to join the United States when it comes to striking back on Tehran.
This is why you didn't get a massive rally in the bond market over the last 3 days or so. Check out 2s this morning, still around 430. Check out 10s. 10s this morning, up a basis point, around 462. Heading into a Fed meeting, and we said this repeatedly on this program, if you're an official at a central bank and you were pinning your call on what happens in the Middle East between now and the end of summer, you need to look for a new job, because you don't have much of an argument to begin with.
Which is why you're not expecting a significant move one way or another as a result of near-term fluctuations in oil prices. That said, in some ways, the market's been doing the Fed's job. If you're worried about inflation being too high, you've seen a general tightening of financial conditions, with the NASDAQ down more than 5% since the last Fed meeting, and spreads wider on both high-yield and investment-grade bonds. They want to keep this going if they want to get inflation under control, even if it doesn't necessarily require hiking rates today.
You know, we talked about the three-part act of the ECB, statement, news conference, and then the post-game reports. I think we're entering that phase potentially for the Federal Reserve. Three-part act, statement, news conference, not much in it. And then afterwards, you start to find out what actually happened at the meeting. You get the speeches, and they take on additional importance. We'll have this conversation later this hour. I think it might be a new era for the way we think about the Fed decision, when it's made and the implications of it.
Does Kevin Warsh still have the leadership role where he sets the tone on the Fed? Because right now, a lot of the rhetoric seems to be from other Fed officials who are filling a void because Kevin Warsh has not given us his view. And so suddenly, Chris Waller's voice is as strong right now as Kevin Warsh, because we're not hearing what the lodestar is for Kevin Warsh.
We have been talking about this for months. If you don't offer forward guidance, if you're not going to offer a framework to financial markets and commentators, then someone else is going to fill the void. And that's potentially going to happen after this meeting.
That decision, 2 p.m. Eastern Time. The news conference 30 minutes later. Coming up this hour, we'll catch up with Julian and Emanuel of Evercore on the sky-high earnings expectations. Colonel Wayne Sanders of Bloomberg Intelligence as a surprise Iranian attack sends crude climbing this morning. And we'll catch up with Claudia Sahm of New Century Advisors, with Wall Street flying somewhat blind into a Fed rate decision. We begin this out with tech stocks looking for stability going into back-to-back risk events. Julian and Emanuel of Evercore writing the following. This week is very important. For the bull case to resume, we want to see positive share price reactions from the hyperscalers and stabilization in the semis. Julian joins us now for more. Julian, good morning.
Good morning.
We do not have stabilization in the semis yet. We might this morning briefly, not on SK Hynix certainly. Are you expecting some positive reaction to those hyperscaler earnings later on this afternoon?
So you set the narrative at the beginning here is that the share prices of the hyperscalers have been so battered, and the narrative around the increase in CapEx set last week by the first hyperscalers announcement and the poor price reaction there. The bar has been lowered sufficiently, in our view, that you really are sort of setting the pace for a potential positive reaction. But the bigger question, and that's been the question for weeks and weeks and weeks now, is that days when software and the Mag 7 work are days when the chip stocks sell off. Can you actually have them work together? And I would say it would be interesting and somewhat ironic if you had an earnings miss like you had overnight in Korea, and then we'll hear again from the other part of the tag team in Korea, whether earnings misses actually are what forms the bottom and results in the end of the Korean retail selling, which really has been the proximate cause for a lot of this.
Do you think we're going to have that washout? Are you seeing that washout now? All that leverage, importing some of that volatility into America, are we washing that out now?
Yeah, we definitely think that's the case. And look, again, and we've said this a lot of times, if you're a tech stock investor, you have to be comfortable with higher volatility. And frankly, if you had told me that Korea would have been down, whatever the number is, 33, 35% from the top, and the NASDAQ barely down that 10% threshold, I would say that's probably not a bad result.
So what would it take for you to get all in and say, OK, we really have reached some sort of bottom where you could see both of these sides of technology working together?
Well, I think the first lesson is, if you're a portfolio manager, is that given what we've seen of the volatility of the last several months, not just to the downside, to the upside too, the concept of all in is a little bit different, right? So because the volatility is higher, and we expect it to be higher for the medium term, probably the rest of this bull market, all in means slightly smaller positions. But for us, actually, again, it's how the shares react to what we're going to hear in the next couple of days. And then I would also say how the reaction to the unlock of the additional float in the world's largest IPO next week, how that reaction comes about.
You mean SpaceX, and just what's been happening to their shares since the IPO, and it has performed worse than 90% of all IPOs of its size going back to World War II. How does the Fed factor into this? Is some of the tightening that we're seeing, and frankly the sell-off in big tech, related to a much more hawkish tone than people expected at the June 17th meeting?
Well, yeah, no, absolutely. Because remember, and this is different from the March sell-off in technology. It was very apparent. There was massive hedging visible in oil, massive hedging visible in the larger credit indices, massive hedging visible in the triple Qs. Not as apparent this time, because a lot of the hedging is actually happening in single name stocks and single name credit default swaps. And, you know, when equity investors start paying attention to credit default swap price action, not even on the indexes, but on the single names, you know it's a little bit more difficult of something to parse. And so we would look for a little bit of tension to release, just given the passing of whatever it is he is or isn't going to say. And we don't think they hike this time. But frankly, if the narrative is as it was in June, we're worried about 2%, we're focused on 2%, that's good, because you anchor the longer end of the yield curve, and that is going to be very helpful for the debt issuance of the hyperscalers.
Not to throw even more shade at equity investors, but when they start to become fixated on bond auctions, when I see that turn, when I start to see the equity guys look at the bond auctions and how they priced, then I know maybe the yield story's gone too far.
You mean when suddenly the 7-year yield in the 7-year auction matters?
You know, like the pure equity guys that never even look at fixed income.
I think that means welcome to the club. I think that you're focused on the right thing because ultimately is the cost of funding, and that gives you a sense of just where we are right now.
Are you also focused on what's going on with oil? In your last note, you talked about 80s manageable, 95 is danger zone. Could the Fed look through 95 or higher?
No, they won't look through it. And if we're talking about $95 WTI in September, you better believe the rate hike regime will begin. We don't think that's the case. Our view is sort of mid-80s is the landing zone for WTI. But here's the other issue, right? Think about it. We have had, I mean, again, as you said earlier, if you're a central banker and your base case is predicated on the movements in oil, you have neck pain from the whipsaws over the last 4 or 5 weeks. And the whole thing about markets is part of the reason that this bull market has been able to be as robust as it has been is because the 10-year yield, every time we look, it's either 430 or 450, for 4 straight years. And if we had more stability in the oil price at a number we think we could live with, call it the mid-80s, that would be a positive.
Someone messaged me the other day and said, never do a trichet. Never go full trichet and start hiking interest rates purely because of what happens with crude. That was the ECB a long time ago. Crude this morning, Brent 87. 82 on WTI. Julian and Emanuel of Evercore is going to be sticking with us. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. SK Hynix shares plunging in Korean trading. The company's record profits still falling short of sky-high expectations. Executives say they're signing long-term contracts with no end in sight to explosive demand. They expect demand to outpace supply until at least 2030. Deutsche Bank shares gaining in German trading. The bank reporting revenue from fixed income trading that jumped in the second quarter.
We had record flows from asset management, almost 9% growth from our private bank. Our corporate bank is continuing to show signs of progress, which we assumed. Continuing to invest across the franchise, capital position strong.
Deutsche Bank also announcing a new share buyback of more than $560 million. The OpenAI agent that breached Hugging Face also compromised a customer at a second technology company, Modal Labs. Hugging Face says the agent broke into an isolated testing environment known as Sandbox that Modal was running for a customer. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour in about 30 minutes' time. Up next on the programme, a return to hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Honestly, they haven't seen anything yet. We've been nice. Every time they hit us, we're going to hit them 20.
That's exactly what happened in the last 24 hours. Colonel Wayne Sanders of Bloomberg Intelligence joins us next, live from New York City this morning. Good morning. I've said repeatedly the week begins on Wednesday. In many ways it does, because we've got some big events taking place, but I already feel exhausted, and I'm sure you do too, after the last 2 days. Doesn't feel like we had 2 days off, that's for sure. The Federal Reserve interest rate decision just around the corner, 2 p.m. Eastern Time. 30 minutes later, a news conference with Chairman Warsh. Then after the closing bell, no rest. Microsoft and Meta reporting after the close. Into that 5-day slide on the Nasdaq, the longest since January on the Nasdaq 100 this morning. A small bounce, up 1/3 of 1% on the Nasdaq, on the S&P, up 1/4. In the bond market, 2s, 10s and 30s just hugging. Anchored around 430, up 2 basis points this morning. With this move in crude, it's a bounce back. Crude higher, WTI and Brent. Brent crude around 88, higher this morning by 4.5%. Under surveillance this morning, it's a return to hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Every time they hit us, we're going to hit them 20. When they hit, we hit. We use their language. Honestly, they haven't seen anything yet. We've been nice. We want to get it over with
and we want to do it right.
So here's the latest this morning. A multi-day pause in fighting coming to a halt. Crude climbing as the US intercepts a surprise Iranian attack on army bases across the Middle East. Bloomberg's Tyler Kendall has the latest in Washington. Hey, Tyler.
Hey, John. Good morning. Well, this marks a major escalation amid a new threat that another front in the war could be opening. CENTCOM confirmed in a statement overnight that the U.S. military intercepted successfully multiple missiles launched by the IRGC at U.S. forces. But this came after Saudi Arabia confirmed that it, too, intercepted successfully multiple drones launched by Iranian-backed proxies from Iraq, prompting U.S. and Saudi forces to team up to hit sites in Iraq overnight, targets that Saudi Arabia hasn't hit in years. Washington has been trying to dilute Iran's power over these proxy groups, with President Trump telling me earlier this week that the U.S. remains in constant contact with Saudi Arabia regarding the Houthis in Yemen as commercial shipping continues to be disrupted in the Red Sea. And at this point, traffic in the Strait of Hormuz remains halted. The IRGC said overnight that it successfully halted at least 3 tankers that were trying to transit through amid new reporting that the country has turned down a new proposal by Oman that would have sought to reopen the strait to traffic. John, that would have included utilizing the so-called Middle Passage, giving both countries equal control over those transits. But we heard from an Iranian official saying that so far the country is vying for what they called, quote, sole control over any traffic that is trying to get through.
And Tyler Kendall with the latest in the nation's capital. Tyler, thank you. More from Tyler in the next hour. Joining us now to extend the conversation, Colonel Wade Sanders of Bloomberg Intelligence. Colonel, welcome back to the program. Every day I wake up and go through these stories, I'm always thinking about what's new, what stands out here. And what's new is Saudi Arabia. Saudi Arabia teaming up with American forces to strike Iranian-backed militia in Iraq. What's the significance of that to you?
Yeah, I'd take that as a huge significant area right now because Saudi Arabia controls the largest Gulf state Arab air force. It's also one of the key areas right now. They've always been a missile defense supporter and a logistics area for the United States, but they've mainly stayed out of it. So now that Saudi Arabia is entering into this as an active, overt participant with some of these strikes, it's letting them know, letting the rest of the world know at this point in time that they're starting to move forward with this, that they've had enough. It's also, given the fact that their influence over the GCC, that plays a huge part in this as well, in my opinion, because countries like UAE, Bahrain, and Kuwait normally end up taking some of their leads as well from somebody like Saudi Arabia.
So are you suggesting potentially we could see more active entrance from the likes of the UAE or Kuwait or Bahrain as well?
Yeah, I wouldn't be surprised, especially when you look at UAE. They have asked for a UN Security Council resolution to allow them to enter the conflict, for the last few months. This isn't something that's new on that front. They've they've stayed back a little bit in terms of that, but with Saudi Arabia being able to add in the area that they currently have, UAE with their capabilities, not only from an intelligence, surveillance, and reconnaissance area, but also some of their expeditionary capability along the coast and the strait, plays a huge part in this as well. Because I think that when you look across, now when you start entering this, up until now, U.S. has somewhat felt alone with the Gulf states being in a very supportive role. But now what you're seeing is actually more of a partnership role, and I think that's going to be very significant going forward.
CENTCOM yesterday said that the IRGC forces when they launched these multiple ballistic missile attacks, it was a, quote, surprise. Do you understand what prompted that?
No, all I can think of is that at that point in time, IRGC thought that they had a target of opportunity to be able to go through. I think at that point in time, when you look at some of the military channels, if you will, to say, hey, look, right now we're in this pause right now to allow diplomacy to take another chance, that both sides are like, OK, all right, we're going to just sit here and let that piece play out before we resume anything. And the fact that those actually took place and those missile strikes started coming back in, I think CENTCOM, while they're always going to be prepared, I don't think they were expecting it as a most likely course of action, but they always look at it as the most dangerous course of action.
Colonel, a couple of months ago, people thought that wider involvement of more actors in this war would be problematic, that it would turn into a regional war, and that would only escalate the potential damage and length of this conflict. Are things viewed the same way right now, with the potential of other allies getting on board in addition to Saudi Arabia with the active fighting?
I don't actually think so, simply for one fact. None of these Gulf states right now are talking about adding into something that would end up in a ground invasion. The United States is not looking at a ground invasion, so you're still looking at air power being the predominant method for this delivery. So now what I think you're seeing is more of that shift for a vocal GCC vote that says, we have had enough of this. We've done everything that we can at this point in time to support in just a defensive role. But especially when you look at the Houthis from Yemen, as well as the Iran-backed militias coming out of Iraq, Saudi Arabia has to be able to defend itself. And the fact that they're doing this in an offensive way, I think is a good sign where the rest of the world is looking, going, OK, the U.S. is not an aggressor here in this. It's Iran refuses to come to the table no matter how many times we try to come back for diplomacy.
Colonel, it's good to see you. Thank you, sir. Colonel Wayne Sanders there of Bloomberg Intelligence, struggling to break out of this, Bramo, struggling to break out of this uncomfortable new normal, just switching between strikes and diplomacy with no sustainable diplomatic off-ramp.
When you ask people what's a resolution that seems sustainable, they say, well, you're looking at it. Ultimately, there's not a whole lot of other options, given the fact that the IRGC doesn't have a lot of levers to pull. Why would they give up their control over the Strait of Hormuz? And right now, it doesn't seem like there is the political will to do some sort of ground invasion that could potentially change that kind of new norm.
We've got Julian and Emanuel of Evercore still with us. Julian, let's go through things year to date. We've had an 80 basis point move on a 2-year yield so far year to date, 80 plus basis points. On crude, we've had a move of, let's say, 45% on Brent. Year to date. We've had that shock through energy, that ripple through rates. Do you think we can avoid a growth scare? Because I don't see that in the equity market. The equal weight closed at an all-time high in yesterday. It's worth pointing that out. Do you see a growth scare on the horizon?
We actually don't, but this is a playing with fire concept. So just to level set, look, jobless claims last week were the lowest since 1969, when the population in the United States was 2/3 of what it is now. That tells you how strong the economy is. But the issue for oil is there are times when it doesn't matter and there are times when it does matter. And part of the tension around hyperscaler capex is due to the fact that oil price volatility is underpinning yield volatility. And that is the flow through on how the debt markets will be receptive for what is likely to be substantially more issuance over the next 6 to 12 months.
Does it make sense to you that the equal weight, that the more consumer-facing aspects of the equity market are outperforming during a time where there's increasing concern about oil volatility and higher yields?
Well, what it tells you is that in this environment, in this liquidity, in the strength of this economy, there's still lots of demand for equities. Okay, and it also tells you that investors are looking for more creative ways to find diversification from what has really become one gigantic AI trade, whether it's the bond markets or it's emerging markets. Everything's an AI trade. So in that environment, look, insurance stocks, part of our negative beta basket, they're like the new meme stocks. They're screaming they've made new all-time highs. Consumer stocks very strong. But again, it tells you the backdrop for investing and the appetite to own equities is still there.
Julian, it's good to see you. Thank you, buddy. Julian Emanuel of Evercore heading into earnings from Microsoft and Meta later on this afternoon. Before that, a Fed decision at 2 p.m. Eastern Time, 30 minutes after that news conference with Kevin Warsh, the Fed chair. The move we've seen in this equity market, we mentioned the equal weight closing at a record high. Check out the banks on the S&P. As a sector, the banks are up for 9 consecutive weeks. If we close out a week in positive territory, the longest weekly streak on record for the banks on the S&P. It's not just the major names, the regionals. The regional bank index up by close to 20% so far year to date. So what's going on in financials?
Fair to say this is not exactly a growth scare. This is quite the opposite. And this has come even as a result, or even as we see oil prices, or despite the fact that we're seeing oil prices rise and yields rise. How long can that continue? Well, Jonathan Krinsky, who actually got ahead of the semi move yesterday, put out a note where he was saying he wouldn't necessarily get all in, but maybe stop selling some of the semis. Now he's getting bearish in the equal weight. He's saying maybe that's going too far. So, there's some discussion under the hood here.
Futures this morning waking up to a positive story, up by 0.2 on the S&P. Up next, we'll catch up with Ted Mortonson of Baird as Wall Street awaits a double dose of tech earnings. Plus, your Haigh has your morning move as a check on SK Hynix ADRs. That stock is just about unchanged. Equity futures stabilizing positive, 0.25% on the S&P 500. The market cap S&P 500, the equal weight yesterday, record highs. The epicenter for this pain is in tech. Within tech, it's in semis. The Nasdaq 100 sliding for 5 consecutive days, the longest run since the start of this year. On the semis, 4-day slide, the longest of the year so far. And that's where things have got a bit dicey. And even with fantastic earnings, we're failing to spark a rally in that particular sector. The next stage of the story is the double dose of Mag 7 earnings after the closing bell. Those names have been beaten up, and Bramo, you pointed that out. Those two names have been trading in a bear market. The bar for them should be lower. It should be lower. We'll see how low that bar is a little bit later.
And potentially the volatility that's been exported, as you point out, from South Korea may not affect them quite as much, given the fact that they seem to be focused on the semi names. That said, CapEx still front and center with respect to the concerns. SK Hynix also exceeded expectations when it came to CapEx expectations. So you might say that that's part of the story. If you do see an increase to capital expenditures without a pathway to pay for it with additional free cash flow, do they suffer the same fate as Google?
When you flip into negative free cash flow, you become dependent on this, the price of capital. And you turn to the bond market, 2s, 10s and 30s, and you can't engineer a rally right now in the bond market, really, even with a 16% turn lower in crude in 3 days. 2s still around 430, 10s around 460. There are plenty of reasons for that. We'll talk about a few of them in about 5 minutes' time. But one is the additional supply that's compromising the cost of capital here, there, and absolutely everywhere.
Yeah, and we saw that with some of the auctions this week, with a little bit of pushback, even with yields at the highest levels going back to 2024, at least in the 7-year yesterday. Look, this is coming amid also concerns about stickier inflation due to the incredible earnings from all of the other non-Mag 7, non-tech companies that we've been getting. Yes, I know you've been saying that the week starts on Wednesday. Nonetheless, we have been getting earnings from a whole host of different companies, and they have been beating expectations beyond the kinds of beats that we have seen in the post-pandemic era. They all are continuing to show resilience. So this speaks to a continued ongoing strength in the economy, despite what we're seeing in oil, and part of the reason why you're not seeing some of those oil price declines get priced into lower yields.
People are still spending. You see that in credit card companies. Still drinking sugar water. You see it over at Coca-Cola.
Yeah.
Still riding those cruise ships. You saw that earlier this week too.
You want me to do this again? Float in the boat with the Coke? I mean, this is essentially what we see, and we see it pretty much around the world, with a huge asterisk of potentially the Middle East travel. But yeah, people are traveling. You look at Hilton, you look at Coke.
I was setting you up to do it again. I wanted to hear it.
You wanted to hear it again?
Yeah, just, you know.
I actually was trying to make a song with it last night, and I decided not to.
Okay,
because it might come out.
Playing around with ChatGPT again.
Yeah, I was just like, you know.
Make a rhyme. Let's not do that, Bramo. No. Let's not do that.
Okay.
Maybe you wanted to do that. I don't know, but
I didn't really, but
I'm not interested this morning. Let's turn to crude. Brent and WTI. Brent crude this morning. This is your bounce. Look, 4 days of quiet, relative calm, and then you've got a spike. You're going to keep waking up to this kind of thing. This is the uncomfortable new normal. You'll have a series of talks. They'll break down. You'll have some unsustainable proposals, unworkable proposals. That'll break down too. And that'll all be punctuated with strikes, and that's where we are. So I don't want to overweight the strikes. I don't want to overweight the talks. I just want to observe that this is the new normal right now, and crude is still elevated.
It's purgatory. It's not full-out war, but it's certainly not peace. And on top of the fact that we have these strikes, you also have Iran rejecting this proposal from Oman to divide the control of the Strait of Hormuz. For them, it's all or nothing in terms of a toll and their physical handle on the Strait of Hormuz. Also, Saudi Arabia, according to our reporting, their state oil giant Aramco is preparing potentially for new selling price for oil. So you can potentially expect a step up when it comes to these products.
That's the cross-asset price action this morning. A few hours away from the opening bell. Make it 3. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start over in South Korea with SK Hynix. Shares falling 6.2%, but fell as much as 19% earlier over during that session as those leverage bets also unwind and exacerbate the selling. The company did post another record quarter, but still it was not enough to clear the high bar. Operating profit rose 557%, but still fell short of expectations due to those elevated expectations. Add to that higher CapEx spending projections that it announced, and you get the reaction that you're seeing over in South Korea. Turning to Ford, as Lisa was saying, good earnings and a good reaction here. Shares are up nearly 5% in the pre-market after the automaker raised its full-year profit outlook for the second time this year. It's being helped by strong demand for its SUVs and pickups, and that's helping to offset things like tariff pressures and weaker EV sales. And it's worth remembering that Ford also had a very high bar. Since May, shares have surged more than 40% on excitement over its energy business, which investors hope will hopefully supply batteries for AI data centers. And sticking with AI, we turn to Seagate. Those shares also up 5% after the company beat and issued a stronger than expected outlook. The stock is already up 160% so far this year as investors bet that AI will drive demand for storage. And that is something that the CEO confirmed, saying that they see momentum continuing in 2027. John.
Yahara, thank you. Thanks for the update. Three of the movers, some of the movers in the pre-market this morning. On our radar this morning, our top story, the US intercepting a surprise Iranian attack on military bases in the Middle East, bringing an end to 4 days of calm. Officials saying US and Saudi forces carried out retaliatory strikes against Iran-backed militants in Iraq. Elsewhere, a Fed rate decision due at 2 p.m. Eastern Time, followed by a Fed Chair Kevin Warsh press conference 30 minutes later. Investors widely expecting policymakers to hold rates steady, but not ruling out the chance of a surprise hike. And finally, SK Hynix earmarking at least $31 billion in capex after reporting a six-fold surge in profit in the second quarter and posting margins of more than 80%, still failing to spark a rally. The stock taking a beating, down more than 50% in a little more than a month.
I'm not sure what we can take away from this, considering that those shares are still up 120% so far this year. Is this more an issue of leveraged traders suddenly realizing that it doesn't only go in one way up? We've seen the South Korean stock market, the Kospi, become more volatile than Bitcoin this year. So you start looking at that and you start thinking, do any of these fundamental numbers actually matter? Because they didn't seem to matter on the way up, so they're not going to matter on the way down.
It's like the whipsaw that we just heard from Julian and Emanuel talking about oil prices. That's what it's been like in Korea. But the fact that operating profit rose, as you mentioned earlier, 557%, and still wasn't enough to get it done, just goes what we've been saying all week. The bar is so high for these companies, and not only do you have to meet the bar, you really need to exceed it.
Price and positioning. That's what we're learning here. Price and positioning. And as for positioning, tons of leverage that needed to be washed out. And once you got that spark, once you had that spark, you were going to light fire very quickly to wash out that leverage in South Korea.
I love reading some of the stories, the anecdotes of people who talked every morning about stocks in Korea. They'd come in, they'd tell their friends how much money they'd made, how they invested in these leveraged ETFs, these leveraged funds. Now, all of a sudden, everyone's quiet. They just sit there depressed, wearing all black.
That stock has been absolutely hammered. I don't think Dan Ives is wearing black yet, is he?
I doubt that.
Still the second inning.
Come on. Yeah. 10 a.m.
Give it a chance.
Lights are still off.
Without a
Cops
doubt.
have been called.
Right, something like that. A certain innings, and then a sports star.
Yeah, exactly. You know? Yeah.
Massive capex concerns putting the AI trade on some shaky ground. Tech heavyweights Microsoft, Meta reporting after the bell. Ted Mortonson of Baird remaining focused on funding, writing the $1.4 trillion capex estimate for 27 is viewed as stressing the system. The circular finance debate is back on the agenda with clients. Ted joins us now for more. Ted, welcome, buddy. It's good to see you.
Hi.
The cost of capital, the price of capital, is it going higher?
It certainly feels that to me. I mean, one of the biggest events this week was NVIDIA's requirement to provide a guarantee for OpenAI's Ohio facility. I think that's a game changer that you really need to focus on. But to your point, we're going to have to raise a ton of debt and equity to really fulfill the 2027 capex requirements going forward, and that's on top of sovereign debt. So we've got a lot of finance here, and I think when you look at the risk changing a bit on these models, the cost of capital goes up.
What do you mean the risk changing a bit? Is it just tied to the fact that suddenly they've got to borrow more than at certain times their free cash flow? Or are you talking about the competitive threat coming from open source models and cheaper technology emerging from China?
It's a combination of things, Lisa. Number one, I think the component increases, as well as the energy availability, the access to power, if you will, is now becoming an issue on the street. The component increases, if you look at memory's up almost 330%. Other components are up a good 25%. So If you're a project finance manager or doing project finance debt, your assumptions are kind of out the window. Number two is, from a structural standpoint, I look at the funding of this AI trade kind of as a football game in 4 quarters. The first quarter, we were financing essentially the frontier models. And if you look what's happening on open source models and token costs, and what Dr. Karp said interviews a month ago, the models seem to be changing. And with the proliferation of open source, I think that changes the models of AI in a way that it's not steady state like the frontier models would like to have it. It's not just going to be an OpenAI / Anthropic debate here. There are other players, whether it be China or the US. Look what NVIDIA did with Palantir. The deck chairs are being rearranged as we steam here.
Yeah, I love that you mentioned that, Ted, because it was interesting to see that NVIDIA and Palantir put out a letter, an open letter, saying that open source is really important. And notably, it was not co-signed by OpenAI or Anthropic, which are suffering considerably in terms of their potential profitability. Do you see this world as shifting, where suddenly the pain in semiconductors isn't going to help hyperscalers, and pain in hyperscalers isn't going to help semis, and that ultimately you have to see both of these rally in tandem with potentially some losers like that frontier model cohort?
It's very dynamic right now, and I don't look at it from the macro perspective. I look at it from my client's perspective. My portfolio manager is getting hammered on the semi trade. If you were up, for example, almost 105% year to date at the peak, and now you're up 56%, and you decide to jump in the semi pool at the top, you're getting absolutely annihilated. So this is a game of attribution. And when you cannot predict the way the market is going, you tend to move to other sectors. And that's my biggest worry, that we drain the semi pool, and we drain, kind of from a shoot, ready, aim perspective away from tech. And that's the wrong trade. But nonetheless, I really focus on my portfolio managers that are, in most cases, struggling just on attribution versus the benchmarks.
Ted, what do you think the right trade is right now?
I think the right trade is not to trade. I think it's to hold your core positions. There are some people, in the market that are de-risking their portfolios. You can see it in the longs being sold and the shorts being covered. I think the trade is, you just have to get this phase of initial disillusionment past us and really focus on the second half. From a seasonal standpoint, summer's always problematic. This time frame, August time frame, is always weak. And I think some of the portfolio managers may just be taking some, quote unquote, time off until we get to the end of September, where we get a real seasonal uptick in tech based upon not only enterprise spend, but this AI trade. So I think it's just time to take a deep breath and own the best names in the sectors.
And then we can talk about the midterms. Can't wait. Ted, thank you. Ted Mortonson there of Baird. That's what Julian and Emanuel said to me in the green room this morning. First thing I walked in, and he said, a few months' time, you know what we'll be talking about? He was like, midterms, can we wait until the end of...
Talking about it now.
Like end of September. Let's wait until the end of September to deal with that.
Yeah, because right now we've got other things to deal with. I love that we've got portfolio managers and investors that come on, take a walk, take a deep breath.
Touch grass.
Touch grass. Maybe don't trade.
That's quite the year from Jim Zelter of Apollo so far,
Yeah, take
a
grass, take a walk.
Touch grass.
Yeah, I mean, I think that given the frenetic pace of news, I think that all of us feel like that would be a good advice.
Nasdaq futures this morning up a few tenths of 1%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. UBS shares gaining in Swiss trading. The bank launching a $3 billion buyback program after reporting a quarter in which wealth management assets beat estimates and trading revenue surged. South Korea planning to hold an emergency meeting to discuss the latest market rout that wiped billions of dollars from the Kospi. The meeting will be hosted by the country's finance minister and will involve all of the country's top financial authorities. China reportedly holding talks with Yemen's Houthis to discuss allowing its tankers to safely sail through the southern Red Sea. Reuters reporting Beijing asked for safe passage after the Iranian-backed militia pledged to block access to Saudi ports. And that is your Bloomberg Brief. John.
Bonnie, thank you. More from Bonnie in the next hour in about 30 minutes' time. Up next on the programme, seeking clarity from the Federal Reserve.
The lack of forward guidance from the chair has kind of spilled over into a lack of understanding the reaction function, what they're looking at, what the risks he might think are. We really have no idea how Kevin Warsh thinks about monetary policy.
Up next, Claudia Sahm of New Century Advisors, live from New York City. You're watching Bloomberg TV. Equity futures positive here by 0.2 on the S&P, on the Nasdaq by 0.13. It's a bounce back on tech this morning, at least for now, following 5 days of losses on the Nasdaq 100. In the bond market, going into this Fed decision later on this afternoon, overwhelmingly the consensus is no change. But just on the margin, there is a chance. And I'm telling you, there's a chance of a rate hike, and it's a low conviction consensus this morning.
Well, given the fact that we didn't have people necessarily coming out and voting for a hike last time, there were no dissents last time. At the same time, you did see a number of Fed officials say that they do expect a hike this year, and there are 8 basis points of hikes being priced in. It seems like it would be really, really strange for them to do it with a lower than 50% chance getting priced into Fed futures.
Twos this morning around 4:30, yields higher by 3 basis points. Under surveillance this morning, seeking clarity from the Federal Reserve.
The lack of forward guidance from the chair has kind of spilled over into a lack of understanding the reaction function, what they're looking at, what the risks he might think are. We really have no idea how Kevin Warsh thinks about monetary policy. He doesn't have to give us any forward guidance, but we would know sort of how to weigh the incoming information.
So here's the latest this morning. Wall Street expecting Fed Chair Kevin Warsh to deliver a hawkish hold later on today. Some traders still preparing for the possibility of a surprise hike. Claudia Sahm of New Century Advisors writing, Warsh has managed to make the Fed an even bigger focus of attention by saying less. Uncertainty around economic policy was already high. The last thing we need is the Fed adding to it. Claudia joins us now for more. Claudia, welcome to the programme. Do you think that Chair Warsh is contributing to the kind of volatility that might be harmful?
So we are seeing that Chair Warsh is contributing to volatility. Now, where it's most clear is in the federal funds futures market, right? So coming in yesterday, there was still about a 30% chance of a rate hike today. That may not sound like much, but that is very high for that close to a meeting. The only time we have seen uncertainty like that in the past several years have been big moments like liftoff in 2015 or the first rate cut in 2024. There was a lot of economics going on and lots of disagreement on the committee. This time, the uncertainty, that comes from a chair who has gone really low information on how he's thinking about policy.
Low information on a range of things. And Claudia, you pointed out the difference. It's OK to stop providing forward guidance, but he's also failed to articulate his reaction function. What kind of questions do you have for this news conference?
I think one is just to ask Kevin Warsh about his own past words. When he worked on the Bank of England's communication review in 2014, he recommended that they give timely feedback on what the decision was, the rationale for the decision, and he even talked about the importance of a reaction function. So what's changed? That's been over a decade ago, and his thinking could have changed. But I agree with that Kevin Warsh about how he thinks about communication, and I'm having a hard time with it in this moment, though I will say we got all of that information by the time we got to the June FOMC minutes. So it may just be Kevin Warsh wants to change the format we get the information, not necessarily that we get less information. I think it'd be a really good idea to at least get it into the statement today if he doesn't want to say it in the press conference.
Claudia, what are you expecting in terms of the breakdown of dissents versus the majority opinion?
I expect that we probably will see some dissents today in favor of a hike. Lori Logan and Beth Hammock laid out very clear explanations for why they thought, if not right away, maybe sometime soon, it would be wise for the Fed to raise rates to bring inflation down. That doesn't mean that they're going to dissent, but I think they really set themselves up to have that, kind of weigh in that way, because dissents need to be meaningful. People do that when they really feel at odds with where the committee is standing at the moment. Another wild card to keep an eye on, we have seen dissents in recent past on how the statement itself was worded, like what kind of information is conveyed, this idea of do you get a reaction function, get any forward guidance. So I think the statement could be pretty interesting this afternoon in terms of learning where the committee as a whole is.
Do you think that right now inflation is a preeminent concern or excesses and volatility in tech sectors? And I'm wondering this because ultimately the wealth effect has been one of the biggest drivers of a lot of the sustainability in spending. So you can't disentangle these two. And you can hear it in some of the rhetoric from Fed officials over the past couple of weeks.
I would put what's happening with AI in the tech sector largely into risk that the Fed is monitoring. It has had some effect on inflation, so that is something very clear and direct to their mandate. I think I would use what's, the uneasiness in some of the tech sector as just another reason why the Fed doesn't need to be injecting more uncertainty and volatility into the situation. Like if market pricing of interest rates gets out of hand because we don't talk enough to the world, that could be really unfortunate and have effects on other sectors. So I think they're keeping a watchful eye on it, but I would put a lot of that into the kind of the risk bucket, as opposed to something the Fed is going to directly try to react to.
Well, we know they're going to directly try to react to data, but what about oil? What's the timeline on their reaction function to the whipsawing we're seeing in crude?
So this, I think, is one where it really would be helpful to get more information from the Fed. In the minutes, they lump together a whole set of reasons why inflation is elevated, including the conflict in the Middle East, but also the AI demand and tariffs. The thing is that historically the Fed has been very wise to look through swings in energy prices. There's a lot of volatility. I mean, we have seen that just in recent weeks, if not recent months. And so for the Fed to chase oil prices, it has proven to be a mistake. But if you watch like the futures pricing for the Fed, it's clear that markets are reacting to that. Like that piece of inflation, they think is something the Fed will be very reactive to. And I'm not so sure. It might be. This time is different. They're impatient with inflation and they react to that inflation. But that would be a bit off the playbook for them.
Claudia, it's always good to see you to get some clarity. Claudia Sahm of New Century advises some much needed clarity on this institution right now. Just working through the voting members going into this decision, where could the dissents come from? We talked a lot about Hammock of Cleveland, Logan of Dallas, maybe Kashgari of Minneapolis, maybe that's 3. It's the board that gets interesting for me. Never mind the regional Fed presidents, they are open to expressing their opinion. It's the board. Chris Waller, Fed governor, he offered us some data contingent guidance going into the last CPI print. And he effectively said, if it comes in hot, I'm going to vote to hike. Paraphrasing, but he went there. That came in soft. It would be a big surprise if we had the likes of Governor Waller voting for a hike later on this afternoon.
Yeah, although he has come out with rhetoric talking about his impatience with inflation being where it is and talking about concerns about the credibility of the Fed. And clearly he's clashing with Kevin Warsh, according to the Wall Street Journal reporting yesterday. So you put that together. And then you have, Schmidt, that's also a regional Fed president. But you've got these questions right now. Where is the focus at a time where a number of people have remained quiet? I'm thinking of the former Fed chair, Jay Powell. And you have other people who are keeping a higher profile, who are coming out with some pretty strong things to say.
Jay Powell keeping a low profile. Christopher Waller, what's so interesting about Governor Waller is he said, though, I think what everyone on the committee was thinking when it comes to these task force. Tell me who's leading them. I'll tell you what they're going to tell you.
More on the Federal Reserve in the next hour. Dan Suzuki of iCapital, General Karen Gibson of Academy Securities, Amy Gower of Morgan Stanley, and the former Kansas City Fed President, Esther George. The second hour of Bloomberg Surveillance just around the corner.
The lack of consensus on what the Fed is going to do is exceptionally high right now.
We really have no idea how Kevin Warsh thinks about monetary policy.
He's hoping that he can sort of wait out this inflation.
I don't see the rationale for a rate hike.
This meeting puts them on a hold.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures bouncing back by 0.2% on the S&P yesterday. All-time high, the equal weight. 5-day slide on the Nasdaq. The Nasdaq this morning up only a tenth. In the bond market, heading into the Federal Reserve decision later on this afternoon, 2s, 10s and 30s look like this. Yields higher by 2 or 3 basis points on 2s to 431. In the commodity market, happen to drive that move, this bouncing crude. Here's the move. WTI and Brent higher by 5% this morning. 88 on Brent, 83 on WTI. Later this afternoon, a double dose of Mag 7 earnings. That comes after the closing bell. Before we get there to Microsoft and Meta, we have to deal with this at 2 p.m. Eastern Time, a Federal Reserve decision.
And they're coming at a time where the market's pricing in a greater chance of Fed rate hikes than they were at the June 17th meeting. You have about 8 basis points of rate hikes getting priced in. It would be hugely surprising for the FOMC to raise rates, given that you're not seeing a significantly above 50% chance of a rate hike being priced into the market. That said, they want to continue some of the anxiety that's going on because that can help suppress the inflation that so many of them are concerned about.
And this is going to be incredibly important because potentially we're going to get some dissent at this meeting. And then Missoula put out a note saying it's not about if the Fed is going to hike, it's about when. And potentially those dissents mean that potentially we could see a hike this year, even before what I think is interesting, midterm elections. Some people are saying it's September.
And that's the first risk event. And then we get a double dose of Mag 7 earnings later on this afternoon. And that is a risk event for those two names. Those two names have been trading in a bear market for much of the last month or so. And the bar for the others, the bar for the high-flying chip names, has been sky high. Intel, Samsung, now SK Hynix, tremendous numbers, failing to spark a rally.
Yeah, 80% margins, not good enough. 557% increase in operating profit, not enough. Ultimately, how much does this say more about positioning, as you said earlier, and less about the actual fundamentals? Interesting to see what the reaction is going to be in semis to the hyperscaler earnings. Let's say Meta and Microsoft announce CapEx plans that are bigger than expected, which is sort of the way of travel, the path of travel over the past couple of earnings seasons, and they sell off and the semis continue to sell off. What could potentially stymie some of the weakness that we've seen in both sides of a trade that until this year we're still firing on all cylinders?
We got a taste of that last week. Alphabet were punished for spending, Tesla was punished for spending, and semis rallied on the week by about 1%, struggling to get off the map. So we've had a taste of that already. If that continues, then we're in a world of pain for the tech story, and for that matter, the index as well. At the index level right now, though, what are we? 3 and a bit away from all-time highs, 3 percentage points plus. We haven't seen that damage at the index just yet.
And part of it is because the rest of the economy is doing so well. And you've seen the outperformance in name after name that's reported earnings. When you take a look at since that June 17th meeting, you've seen the tech sector, the NASDAQ composite, down almost 6%. You see actually the equal weight up on that time. You see the Russell 2000 up 0.5%. So this isn't coming from weakness in the broader economy. And as long as that can continue, it can offset some of the pain in some of the more momentum trades that are seeing the biggest downdraft that they've seen going back to 2009.
The banks haven't had a down week since the end of May. That's how great the run has been for the banks on Wall Street. Coming up this hour, we'll catch up with Dan Suzuki of iCapital as stocks regain footing ahead of big tech earnings. General Karen Gibson of Academy Securities as a surprise attack by Iran has crude spiking, and the former Kansas City Fed President Esther George expecting today's family fight to end in a hold. We begin this hour with stocks looking to build momentum heading into a blockbuster day for Wall Street. Dan Suzuki of iCapital writing, a robust macro backdrop should fuel a second straight quarter of 20% plus earnings growth. With tailwinds fading in the second half, this may be what peak growth looks like. Dan joins us now for more. Dan, good morning.
Good morning.
Welcome back, buddy, and congratulations on the new seat. It's good to see you.
Yeah, great to be with you guys. Love this show.
Let's draw a distinction between peak growth and peak markets. How wide is that distinction this morning?
It's clearly not very, very distinct, right? I think like in normal markets, it's really more about peak earnings than it is about peak growth. But I think when expectations get really high and the bar is set so high, peak growth is all it takes to sort of get expectations to be too high to meet. And that's kind of what you're seeing today in the AI trade.
Lisa talked about how high the bar is for the chips name. The likes of Intel, the likes of SK Hynix, the likes of Samsung. How high is the bar for the hyperscalers? A couple of names that have been beaten up quite a lot.
I mean, I think what you're seeing, this earnings season is that the bar is set too high for any stock associated with the AI trade, right? And it's not to say that the underlying fundamental story is not good, but the bar is just being set too high. So you can't see any stocks that are up on their earnings results. And I think the way to think about it now is the bar is set so high. the new beat is, call it a 10% beat on earnings and a lower CapEx guidance. I think that's the thing that's going to get stocks to rally.
So this is an area that's controversial. You think that if they underperform, or at least they lowball the CapEx plans and they come in lighter than expected, that would be a case for rally more than anything else. Is that correct?
I think that's part of the story. I think you want to see underlying strong fundamental trends, but also an eye toward monetization of all this investment spending that's happening. And this is something we've been talking about at iCapital for a while. I mean, we call it the AI CapEx vigilantes. And you're seeing the vigilantes are winning these days, right? And you're seeing everybody's waking up to this story, whether it's the hyperscalers, the semis now is a sort of second derivative of that. And I think that's really what's coming to play. So what the market wants to see, what the vigilantes want to see, is signs that there's an eye toward the monetization of that investment.
Do you want to get on the vigilante train and overweight some of the fixed income instruments that have leverage right now and not necessarily go to the equity side of the equation?
No, I think both sides, the reality of what's happening right now in markets is that the markets are waking up to the risks associated with the AI trade across the supply chain, right? And it's not to say that the underlying fundamental story is broken, but, there's a lot of good things happening, but there are obviously a lot of risks. Moats are weak. Pricing power is weak. CapEx is very high. And when you get sort of price wars and price pressures and competitive environments in a hugely capital-intensive industry, that typically, causes a lot of shakeout and volatility in some of the names. And I think that's what you're seeing now.
Do you see any evidence that some of the AI trade is starting to move to other industries that are starting to use and adapt AI quicker?
Yes, absolutely. It's hard to find, I was just talking about this the other day, it's hard to find an area of the market that's not an AI trade, right? It used to be emerging markets, that's as far as you can go. Now, emerging markets is an AI trade. Utilities are an AI trade. Real estate is an AI trade. I mean, where do you go that's not an AI trade? And that's what you're seeing that's up right now, right? You talked about since sort of the May highs, all this stuff is down, but look at all the stuff that's up double digit. That's sort of the other side of the seesaw, the anti-AI trade, if you will.
What are the banks? How would you describe that rally we've seen in the financials?
Yeah, that's part of the story. The underlying fundamentals for the banks are strong. But at the same time, this is kind of the rotation that Lisa was talking about. Like, there's other stuff putting up good growth and accelerating growth at a time when people are starting to think about the risks associated with AI. And I think financials are part of that. Small caps are part of that. Values are part of that. And I think people are just understanding that there's more to the world and to the markets.
Dan, that doesn't scream growth scare. And these are the rolling shocks we've been talking about through energy, through interest rates, through the bond market, but it hasn't materialized with a growth scare. Is that on the horizon? How avoidable do you think it is?
Growth scare, I mean, you'll have to help me define that, John, because I think one of the two other things that we highlight as risks for the second half of the year are sort of fading tailwinds to the consumer. And then also higher for longer interest rates. Both of those things are actually happening. And so I think that our base case is that growth does slow in the second half of the year. The real question is how much. And there are a lot of tailwinds that are mounting, and liquidity, we're probably past peak liquidity for the year. This is not a great environment for accelerating growth.
Just sit on that point of tension just for one further beat. You can see a situation where the consumer tailwinds slow, but rates remain elevated.
Yeah.
Can you explain that?
Yeah, I mean, I think if you just look at the sheer amount of tailwinds that have been boosting the consumer, whether it's tax cuts or just the reopening of liquidity, there's been a lot that's gone into boosting the overall economy in the first half of the year. Just look at any measure for the second half of the year, right? We've already paid out the record, tax refunds. That's sort of in the rear view. They're still in their pockets, so they can still spend that. World Cup is now behind us, unfortunately. Liquidity is tightening up. So as you look at the second half of the year, it's more likely than not that growth is going to slow. But, inflation to me right now comes down to what's happening in Iran, right? And so whether or not the Fed hikes or whether or not inflation accelerates, to me, that's an oil story right now. Even though they say they're going to look through that, when you have tariffs and oil, two shocks, I think that makes the story a bit more difficult for them.
Putting oil aside for a second, if you do think that there's going to be a slowdown in growth heading into year end, are you expecting rates to go lower, at least the Fed funds rate, and potentially not glean a whole lot right now, but more by that going forward about Kevin Warsh?
This is why we had the base case that, we're going to have the Strait of Hormuz is going to open up. growth was going to slightly soften, and that was going to keep the Fed on hold for the rest of the year. And that's still our base case. But I think oil is the wild card, and that's going to really drive what happens with interest rates. If you take out what's happening in Hormuz, I think interest rates do fall into the end of the year. But if you reintroduce this story, I think you're seeing an increasing risk that at the September meeting and beyond, you start a hiking cycle. I think that's what the Fed is telling you. There's if you look at the Fed minutes, it was basically a scenario analysis of what they plan to do based on what happens with inflation, which is very much driven by oil.
Why wouldn't they look through it? I mean, we've been talking to one analyst after another about how they always look through oil, and actually that the inflation coming from other areas seems to be more prevalent, including capital markets, which seem to be slowing down, at least if you view what we're seeing in the wake of earnings. It's
just going on for too long. Right? And inflation's too sticky for too long. He keeps hearkening back to the mistakes that were made after the 22 oil price spike and the inflation that we saw. Then, we're looking at it. Just listen to what the Fed, speakers are saying. They're saying, if this keeps going, I'm going to start hiking rates. I want to start hiking rates. And that's what they're telling us. That's what the minutes told us. And so, yes, in all else equal, they're going to look through tariffs. They're going to look through energy. But the more that this goes on, the more that bleeds into inflation expectations. And by the way, core PCE, what did that bottom 2 years ago? And that's been rising. I mean, these are not good trends for the Fed to sit on.
Dan, I've missed you. It's good to have you back. Thanks for being here.
Thanks for having me.
Thank you, buddy. Dan Suzuki there of iCapital on this market. Heading into this Federal Reserve decision later on this afternoon. Equity futures right now positive by 0.2. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. BMW is cutting about 8,000 jobs globally. The car maker is offering voluntary severance packages to corporate and research staff. BMW aiming to streamline operations and cut management ranks to better compete with rivals from China. Porsche reporting earnings that beat expectations, anchored by the success of its high-margin 911 sports car. Operating profit jumped 34% to $1.5 billion. Shrinking sales in China and U.S. tariffs continuing to weigh on the company. Meta CEO Mark Zuckerberg saying the U.S. administration shouldn't block Chinese AI models. In an interview with the Financial Times, Zuckerberg is saying regulations pushed by leading American labs could stifle domestic competition. Zuckerberg adding that restricting the most advanced models is the wrong approach to cybersecurity. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie later on this morning. Up next on the programme, reigniting hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Honestly, they haven't seen anything yet. We've been nice. Every time they hit us, we're going to hit them 20.
Up next, we'll catch up with General Karen Gibson of Academy Securities, live from New York City this morning. Good morning. Going to be a long one at 2 p.m. Eastern Time. We'll hear from the Federal Reserve. 30 minutes later, we'll hear from the man in charge. We'll hear from Kevin Warsh, the Fed chair. How much is he in charge right now is a notable question. After the closing bell, we'll hear from Microsoft. We'll hear from Meta. A double dose of Mag 7 earnings after the closing bell. Into that, your scores look like this. Equity futures on the S&P 500 bouncing up 0.2%. The Nasdaq sliding for 5 consecutive days, bouncing this morning by a third. Within the Nasdaq, the chip players really struggling, Lisa. 4 days of softer stock stories for the chips over the last week.
Yeah, part of this is a positioning story. Part of this is the China competition story, with the potential for them to introduce a cheaper competitor to offset some of the incredible demand for memory chips. And some of this is a feeling that you cannot continue to have 80% margins for a very long time before somebody is going to try to disintermediate and compete with you. And ultimately, how much is their profit sort of a problem of their own making, as we heard Jason Thomas of Carlyle say yesterday.
Your margin is my opportunity.
Exactly.
Right, like if you're putting up 80% plus margins, hello competition. It's an invitation, isn't it?
And frankly, that's capitalism. And that's what actually should happen at this kind of point. And frankly, you're seeing the costs for CapEx go up so much for a lot of these hyperscalers because of the component costs from things like those memory chips.
So you've got the threat of increased competition and capacity. You've seen evidence of stretched price and positioning. You can see that in the way the stocks have responded to fantastic earnings. And now you're starting to see this take place. We're starting to think more and more about the financing of the ecosystem and an increased cost of capital. In the bond market this morning, two's around 430. 10's around 460. The cost of capital, not just for the Treasury, but also for the tech names. And maybe, it's an odd world we live in now, where the Federal Reserve might be even more important now to the tech names, and the tech names might be even more important now to the bond market, which was something you mentioned a few days ago.
In some ways, the tech names are the big duration play right now. They've been borrowing a lot of money on the long end of the yield curve. They have expectations baked into their valuations that go out a decade or more, that they could potentially continue to have these types of profit margins and profit increases. And right now, there is a question about what they're doing to the economic growth. All of this coming together with Julian and Emanuel saying, that you have a problem when stock investors start looking at credit default swaps of individual companies. And that is where we are.
And auctions, too.
And auctions.
Well,
I think everyone
I track that on X when I start to see people post the headlines of the results of how much a particular maturity tailed and people freaking out and stuff. It's like, oh my goodness. When I see that on my radar and then I check the account and usually the hits are like all about equities. And then there's this one straight headline
2 basis point tail.
Right?
Yeah. I saw it.
Then you know that maybe things are a little bit stretched.
Well, people are looking for a narrative, too, that this is sort of coming from those credit markets and whether maybe we're getting to the end of that or whether we're just beginning. I don't know. It's a new narrative. Freak out about credit and watch the auctions.
Freak out about Brent as well, up 5% this morning, 88 on Brent. Let's talk about the situation. Under surveillance this morning, reigniting hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Every time they hit us, we're going to hit them 20.
When they hit, we hit. We use their language.
Honestly, they haven't seen anything yet. We've been nice.
We want to get it over with, and we want to do it right.
It's not over. Here's the latest this morning. Crude rising as fighting resumes across the Middle East. The U.S. intercepting surprise Iranian strikes on army bases in the region. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, new within the last hour, we're tracking closely whether the U.S. has resumed strikes against Iran this morning, as Iranian state media reports that a missile hit in the country's northwest near the border with Iraq. Now, we should say the U.S. has not confirmed this, but it does come after significant escalation overnight, with CENTCOM saying that it successfully intercepted multiple missiles fired by the IRGC at U.S. forces. And there is this renewed focus on Iraq as potentially another new front in the war after we saw U.S. and Saudi forces team up overnight to hit targets there after Saudi Arabia claimed that Iranian-backed proxies in the country fired drones. Washington has been trying to dilute Iran's influence over these proxy groups, with President Trump telling me earlier this week that the U.S. remains in constant contact with Saudi Arabia about the Houthis in Yemen as we continue to see disruptions to commercial shipping in the Red Sea. Pair that, of course, with now continued disruptions in the Strait of Hormuz amid very little indication that Iran is willing to let up its leverage when it comes to commercial shipping. And John, new overnight, we got this statement from Iran's foreign ministry appearing to reject a new proposal by Oman that was geared towards opening the strait. It would have utilized that so-called middle passage, giving both countries joint control. But Iran is saying that their country is only vying for what they said would be total control over any traffic transiting through.
Tyler Kendall in Washington, D.C. To add to this, General Karen Gibson of Academy Securities writing, we may see alternating periods of tension, strike and diplomatic activity in the weeks ahead. Even if tensions die down, they could create a persistent environment of elevated risk. General Gibson joins us now for more. General, what would it take, and welcome to the programme, what would it take to break out of this uncomfortable new normal?
Well, that's the big dilemma, Jonathan. I think settlement seems distant. That's very disappointing news that Taylor's just delivered regarding the Omani proposal for joint management of the Strait of Hormuz. There are simply no indications that Iran is willing to compromise at this time. Their priority is to gain recognition of control over the Strait of Hormuz. And there's no doubt that their economy, which was already weak, is degrading. There are signs of some internal divisions, but let's be clear, it's the security state that's running the show. They don't want to return to full-scale warfare, but they seem comfortable with this current state of limbo. They're prepared to absorb additional U.S. strikes. They believe they're in a position of strength and have tremendous leverage over the president, and I think they think that time is on their side.
General, do you see a scenario where this administration capitulates on the Strait of Hormuz and allows Iran to just control it and everyone has to pay a toll?
Well, I'm not a domestic political analyst, and assessing our own administration's policymaking is not my forte. But certainly I think that is what Iran is angling for. And the extension or the ramped up strikes in Saudi Arabia are interesting from a couple of standpoints. I mean, it is proxies that are doing this, and proxies, particularly the Houthis, tend to act in their own interests, even when they're aligned with Iran. But it could perhaps be part of a broader strategy to raise the pressure on not only U.S. allies, but those who contribute to the oil markets to bring the U.S. to some kind of compromise that we had not previously considered. And I understood that the Omani proposal did, in fact, have regional backing. Our regional partners want to see an end to this. It's very difficult for them economically. It's also difficult for them from a security perspective. But their dilemma is that we can't end this with an Iran that is still powerful to continue to conduct these strikes against them. And I just don't see a ready solution to that in the near term.
Well, one regional partner entered the fight yesterday. How much do you think of what happened last night is about containing the militias in Iraq versus more of a strategy and showing of hand, the fact that Saudi Arabia joining in with the United States on these strikes?
Yeah, that's a great question. You know, having proxies is a bit of a double-edged sword. On the one hand, it gives deniability of responsibility for actions that occur. But on the other, they aren't always fully an entity that can be controlled. The Houthis, for instance, are very willing to accept Iranian financing, Iranian lethal aid, particularly sophisticated weaponry, Iranian intelligence, but not always Iranian instruction. And so I was not surprised that the Houthis began to engage the Saudis. They have a long-running dispute. They've fought 2 wars together, even preceding the Houthis' alignment with Iran. The Iranian-aligned militia groups in Iraq are a different story. And I think in some ways more easy to direct. That was a bit more of a surprise. And I think, frankly, at some point could potentially backfire for Iran if, in fact, they continue to act up.
General, how far could the Saudi Arabian involvement go? I mean, do you expect further military action proactively by them?
Well, I'm surprised, a little surprised that the joint effort with the Saudis and the U.S. was directed into Iraq and not against the Houthis down in Yemen, which has been a persistent thorn in the side of the Saudis. You know, the Saudis, Iran is, again, another area where this may backfire. The Saudis had been working on rapprochement with Iran for years, and they're setting that back. As I understand, there's credible reporting that the Saudis are the ones that convinced the president to stop Operation Freedom after a single day because of potential threats to the East-West pipeline. So the Saudis, I think, you know, they're pushing hard potentially to get them to urge the United States to come to some kind of settlement, but they have to be careful not to push too hard, so hard that the Saudis also, you know, become more kinetically engaged.
General, it's good to see you. Thank you. General Karen Gibson there of Academy Securities. The last couple of lines there, I think reaction to your question, quite important. Surprised that the Saudis didn't hit the Houthis, which makes you wonder whether they're next.
Yeah, given the fact that they've had a long-standing conflict, they had some sort of ceasefire, believed to be sort of grease the wheels by payments from Saudi Arabia to the Houthis. Now you've seen the Houthis threaten the Red Sea. Does that start to change, considering the actual threat to their financial welfare?
It's all these militia groups. And when you have drones coming from Iraq into things like trying to target Abqaiq, which we've seen in the past, take out massive Saudi supply, they're going to have to do something in terms of setting deterrence.
Iranian forces have been increasingly provocative. We saw that even through the diplomatic phase, and I think the stories circulating stateside about US stockpiles of ammunition are not helping America's cause right now at all.
Absolutely not. They're taking advantage of this moment right now, as well as the fact that it's ahead of a midterm election. They want to see a premium on crude.
Brent crude at 88, live from New York. You're watching Bloomberg TV. So here's your bounce in the equity market on the S&P 500 up by 0.25% on the Nasdaq following a 5-day slide on the Nasdaq 100, the longest since the start of the year. We're higher by 0.3%. Within that, the semis down for 4 consecutive days. Haven't seen a run like that for the year so far. Elsewhere in South Korea, look at this for a range on the Kospi. At the lows, down by more than 12%. At the highs, up by more than 3%, down 6%. That is a crazy session in South Korea, and it's caught the attention of officials in South Korea as well, said to be having a meeting with the finance ministry.
Yeah, the Kospi is trading like a meme stock, and that's a real problem for them, considering the fact that it's more volatile than Bitcoin so far this year. A lot of leveraged funds that are involved with this, a lot of retail involvement. And it's led people to pull back from the overall index, because how do you price volatility like that? You can't. So you walk away, even if you have 557% increases in operating profit. This is the reason why regulators are getting involved. But this is also the reason why people are having a hard time understanding what some of these valuations are anchored to. Is it anchored to highly leveraged positioning, or is it anchored to something fundamental?
I suggest a lot of wealth also created in South Korea as well. We'd often talk about the stat to just how much Samsung accounts for South Korean GDP. I think the increase in wealth you would have seen off the back of this run-up in the stock market, that index, Samsung and SK Hynix alike. It's a lot of money at stake here too, and that market risk becomes an economic risk, which is something you touched on, Bramo, earlier this week with regards to the United States. We haven't got a real economy scare in America right now. We don't at all. I'm not going to go there. You can't see it. But the wealth channel is important here, and if you get a pronounced downturn in the equity market, we don't have one just now, but if you do, then you can have a problem in the economy as well. And maybe what's happening in South Korea right now might be a case study for things in the not too distant future.
You know, Fitch Ratings came out with a report earlier this week talking about how AI is increasingly a credit risk. And it kind of speaks to your point. You're talking about the wealth transmission, the idea that the wealth effect has really bolstered a lot of consumer spending. You're talking about just more broadly with the overall economic growth. You start to see a retracement in that. All of a sudden, you could see some fundamental issues percolate, not just here in the United States, but globally.
That's the equity story. Here's the bond market picture. 2s, 10s and 30s, yields creeping higher, up a few basis points, just anchored around 430 into the Fed meeting later on this afternoon, closing around 418. Around mid-June, the last time the Fed met, by the close of day. So we've added 10 basis points plus to the 2-year and settled there. And we've anchored around the upper end of this new range, going into the Federal Reserve meeting later. And we're trading above the policy rate of the Fed by, let's call it 50 basis points. How much of that 50 basis points is because this market believes with conviction this Fed will hike? How much of it is just about baking in some risk that they might? Because we've got a new era at this Federal Reserve with limited forward guidance.
In some ways, Kevin Warsh's challenge is to keep market pricing here without doing anything. Because ultimately, this is not a Fed that wants to hike. That is quite clear in terms of the waffling and just the fact that they moved from an easing bias to a neutral bias at the last meeting. I mean, this is how far we'd be going if they actually did hike rates. But at the same time, the tightening that you're seeing is marginal enough to take some of the froth out of the market, and they should take comfort in that, but not necessarily take it too far.
The energy move is helping that bond market move this morning. The move in crude looks like this. Let's call it higher by 5% at the moment, up 5% on Brent at 88. WTI at 83.
We're back to strikes after a relative few days of calm. At the same time, the Strait of Hormuz remains closed. The Iranians are not playing ball with the Omanis on trying to open it up. Aramco is talking about potentially having to adjust prices. Neil Dutta wrote in, and he said, for the Fed, this is fool me once, shame on you, fool me twice, shame on me, sending me the Brent and WTI links. Basically saying the Fed cannot look through this anymore. It's too rampant when it comes to what is going on in Iran.
The Iraqis weighing in on the strikes that took place in their territory, saying the following. They reject the use of Iraqi territory to launch attacks. Saudi-US attacks are unacceptable, a violation of sovereignty. Those headlines crossing just moments ago.
So, hey, Iran, stop using us through our proxies to shoot missiles. Right. Saudi Arabia, stop attacking us. Why are we the victim? They're saying, please keep us out of it. Good luck.
It's messy. It's still messy, and it doesn't matter if there are talks or if there are strikes. This is an uncomfortable new normal, toggling between one and the other, back and forth. As we count you down to the open about a few hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Well, here's a clean story. We have Global Foundries, the chip maker, up 9% in the pre-market after landing a $300 million award from the U.S. government. The funding will be used for the company to develop technology that allows AI chips to communicate faster and more efficiently. But it's just the latest sign of Washington trying to bring that advanced chip supply chain here to the U.S. rather than relying on overseas suppliers. like TSMC. Let's get to the earnings we've gotten this morning because we've gotten quite a few. And we start with Humana. The health insurer is falling 7.7% in the pre-market after it beat on second quarter profit, but it left its full year guidance unchanged. And that was a problem for investors since shares had run up some 50% so far this year. It's just the latest sign of the market punishing companies unless you really beat across the board. And we get a check on the consumer with P&G, the company behind brands like Tide. It is down 3.4% after missing expectations and offering a cautious outlook. And that's largely because the company says it is no longer raising prices, afraid of customer pushback. And that's a problem because P&G is facing higher costs from things like raw materials and transportation. And that pressure is already showing up in the earnings. Earnings fell from a year ago for the first time since 2022, and all 5 of its business segments missed sales expectations. John?
Yahara, thank you. Thank you for the update. More from Yahara in our next hour. On our radar this morning, SK Hynix reporting a nearly 6-fold surge in quarterly profit that missed sky-high expectations. The next test for the AI trade on deck with Microsoft and Meta. They report after the closing bell. Samsung, Apple, Amazon due tomorrow. Elsewhere, NVIDIA CEO Jensen Huang meeting lawmakers on Capitol Hill in a bid for open-source AI models, calling them essential for safe adoption. OpenAI CEO Sam Altman is expected to make his way to Washington for similar discussions later this week. And finally, the Meta CEO, Mark Zuckerberg, saying the US should not ban Chinese AI models. Zuckerberg telling the Financial Times that US companies need access to their competitors in order to compete with Beijing.
They want to be able to keep up. It just strikes me that the users of these models want them cheaper, that the creators of the frontier models are like, well,
You're shocked. Do you think there's book talking going on here?
And it's like at a certain point, you have to imagine that the hyperscalers and anyone adjacent to them want the costs of these models to come down. Open source helps do that. It gives them more optionality and, frankly, more access to more markets. Likely the frontier models are a little bit more hesitant to say that, and you're hearing that from some of the commentary from the likes of Anthropic.
Well, when you look at what Mark Zuckerberg said, it's not even just so much about China, and FT talked about this. Him warning about the risk that AI might become centralized in the hands of a few powerful groups appeared to be a broadside against his rivals, Anthropic and OpenAI. And this will be on full display this week, not just the fact that Jensen was there last week, but today, tomorrow, you're going to have Sam Altman there. And that's at a company that's also dealing with a huge risk right now when it comes to an agent getting out and going after actually another company, not just the one we heard about last week.
There's a lot of inside interest here, right? Meta does not have a model. They are potentially pivoting towards becoming somewhat of a neo-cloud maker, a neo-cloud provider. That bolt-on, it's been the talk of the last month or so. And maybe they're going to sell some hardware into China too with the Meta glasses. I don't know. But it's very difficult to listen to these people and not be cynical right now.
How can you not be? I mean, the fact that Meta, that NVIDIA, that Palantir are all saying, we need to open the doors. Well, guess what? They benefit quite a bit. And then you got the people who stand the most to lose saying, regulatory issues, concern, distilling, et cetera.
You need to regulate us.
Yeah, please regulate us.
Right, of course, yeah. Meta and Microsoft reporting a little bit later. Let's talk about commodities. Gold remaining steady ahead of today's Fed rate decision. Amy Gower of Morgan Stanley saying a hold could create a path for the precious metal to rebound back towards 44.50 by the fourth quarter. Amy joins us now for more. Amy, welcome to the program. Let's talk about what's held back gold. Let's start there. I think that's a good place to start. What is holding gold back so far after that massive run-up over the past few years?
Yeah, look, I think 2026 has obviously been a much more challenging year for gold than 2025. And I think, look, with the conflict, we've had 2 big headwinds for gold. So one, we had central bank gold sales. So, the last few years have been very much defined by large central bank purchases of gold. But we had particularly Turkey selling a lot of gold in the initial months of the conflict. And then 2, we've had this big shift in interest rate expectations. So before the conflict, expecting 2.5 rate cuts to now the market pricing about 1.7 rate hikes by the end of this year. And so with that, you get ETF selling. ETFs tend to be very, very sensitive in exchange traded funds to what the Fed is doing. So they've actually also been liquidating. So you had central banks selling and you've had exchange traded funds selling. Now, I'd say at the moment, gold has started to find a bit of stability, and that's because the central banks have stepped back in. So Turkey, that selling has reduced dramatically from about 60 tons in a single month to about 2 tons the last month of data that we have. And actually others have started to buy quite aggressively. So China was buying about 1 ton a month before the conflict and bought 15 tons in June. So huge acceleration there. Poland, which was the largest buyer last year, buying ahead of where it was at this point last year. So we are getting a bit of underpinning, I think, from those central banks. But of course, the bigger question is going to be, will those exchange traded funds switch from selling to buying? And that's where I think tonight and arguably the next few Fed meetings, the decision is very, very important.
Well, Emma, let's stay on the backdrop for rates. Interest rates, how important were they to gold on the way up? And what's that story look like now? And what's your outlook? And how do you factor in what's going to happen with the Fed?
Yeah, look, I think interest rates have been super important to gold. So we had kind of gold's first pivot was in 2022, where arguably gold should have fallen as interest rates were hiked through 2022 and 2023. But because the central bank stepped in to provide that physical support for gold, it sort of was able to stay fairly steady. And then last year, interest rates again played a big role. So central banks were buying, but the biggest swing was the exchange traded funds, which bought nearly as much gold as the central banks. And the reason that they did that was because interest rates were coming down. So if interest rates are coming down, gold is a non-yielding asset. So lower interest rates makes gold more competitive in your portfolio. So a big part of the swing in demand that we had last year was due to that cutting cycle. So that does mean, if we do see a hike today or in September, then you are going to get more pressure from exchange traded funds selling gold. So I think it is very, very important. Our house view is for the Fed to stay on hold, and then there's a bit of runway before the September meeting to get more data that can give them reassurance that maybe inflation is coming under control and they can stay on hold. But of course, if there were to be a hike, I would expect gold to be under some pressure.
Amy, is copper, lithium, the likes of uranium, the new gold right now?
I think there's definitely elements of this, and I think we did see that last year where gold and copper, for example, were very, very correlated, and I think that was really around this fiat currency debasement fear where that was sort of driving investors towards real assets. What we've seen this year is a big breakdown in those correlations, and actually things like copper holding up far better than gold, and I think that also brings you to, you do need the sort of real physical demand to be working. Copper's looking very good right now in terms of you've got the US pulling in metal, you've got China also pulling in metal despite prices being pretty elevated. You've got demand from data centers, grid upgrades that we know are happening around the world. And then you've got a supply side that's very constrained with more risks to come as we have El Nino coming later this year that can bring disruptions in Chile, Zambia, etc. So copper certainly looks very, very good. I'd say lithium is maybe a bit more volatile to be sort of something to be sort of labeled as the new gold, and it does have sort of its own challenges around the supply side and very reactive supply to high prices. And then I'd say uranium does maybe have a bit more of that long-term store of value. There's a sort of a very long-term thesis. There's a sort of limited supply, but again, it's not quite behaved as gold. So copper's probably the one where investors would be looking most closely at the moment.
Amy, I know you also see some more upside room to run when it comes to silver. What's the thinking behind that?
Yeah, so silver has really lagged gold year to date. So since silver's peak in late January, the ratio gold to silver has steadily risen to about 70 times, which is about where we'd expect it to settle long term. But that has happened a bit ahead of our expectations. And similar to gold, silver has struggled with exchange traded funds offloading physical silver, and that has put downward pressure on prices. We've also had headwinds from the solar sector where solar installations have been slower, and then we've also seen some substitution from silver to copper. But I would say silver does have that sort of electrical exposure angle. So if we do have a rally in copper, that often pulls silver with it. And then if we do get the Fed on hold, similar to gold, we could get those exchange traded funds re-engaging.
Amy, it's good to see you. Thanks for dropping by. Amy Gower there of Morgan Stanley on the price of gold. Gold this morning just north of 4K. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Firefighters in Spain and France are racing to contain wildfires before a fourth heat wave in just a few weeks blankets the area. France fears shifting winds and rising temperatures could fan the flames in the southwest. Spain is experiencing some relief from blazes near Madrid. The European Football Association is considering a boycott of FIFA events, including the World Cup. Sources telling us here at Bloomberg the association is upset with FIFA's plan to seek private investment, saying it could give them greater influence over member associations and their national clubs. The Senate confirming Jay Clayton as Director of National Intelligence. Clayton is a former top federal prosecutor in New York. He came under scrutiny during his confirmation hearing for declining to directly say that Joe Biden won the 2020 election. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for the update. More from Bonnie 30 minutes from now. Up next on the programme, a hike versus a hold.
The market's not ruling out July, and honestly, neither are we.
This really is a live meeting. The risk that we do get a surprise is much, much higher.
I've got the Fed on hold for the rest of the year, but I have to say it's not high conviction.
Up next, we'll catch up with the former Kansas City Fed President Esther George, live from New York City. You're watching Bloomberg TV. Stocks are positive, up by 0.2% on the S&P. Some real event risk on the horizon. You'll hear from the Federal Reserve later on this afternoon, and you'll hear from Meta and Microsoft. The Nasdaq into that, up 0.25%. In the bond market, ahead of that Federal Reserve decision, twos anchored around 430, yields higher by 2 basis points. Under surveillance this morning, a hike versus a hold.
The market's not ruling out July, and honestly, neither are we.
He needs to do something, and we think 3 rate hikes is the way to start.
This really is a live meeting. The risk that we do get a surprise is much, much higher.
I think you would get at least 1 dissent if Warsh keeps rates on hold.
I've got the Fed on hold for the rest of the year, but I have to say it's not high conviction.
So here's the latest this morning. The possibility of a surprise hike looming over today's decision. The former Kansas City Fed President Esther George expecting the Fed to stay on hold, writing, although the probabilities of a hike have risen, the outcome of the committee's family fight could well conclude that the cooler June inflation numbers allow them to wait. Esther joins us now for more. Esther, a warm welcome back to the programme. We're in a whole new world. This is different. Typically, post-GFC, we're guided into the decision. We already know what the outcome will be. What do you make of that change, that we actually have just a little bit of two-way risk?
So I think it's a good move in the sense of not trying to forecast and lay the groundwork for upcoming moves. I think the market doing this work is probably an important development here. And at the same time, while you're going to stop short of giving forward guidance, I think it's always helpful to be clear about what you are looking for. So today, I think, will be important to listen to what is the rationale, how is the committee thinking about the current state of the economy.
Esther, if you were in the family fight right now, today and heading into tomorrow, what would you be screaming about? What would you be sort of arguing for?
Well, Lisa, I've been concerned for some time about the duration of elevated inflation in the economy. And yes, we've had a number of one-offs, as we call them, hitting the economy. But the truth is underlying inflation has remained well above the Fed's target. And so my own sense is the cuts last year really eased into something that was still a problem in terms of inflation. So I would continue and am continue to be concerned about elevated inflation.
Do you think that it would be appropriate for a number of dissents today? Do you think that that would be healthy, or does that indicate that maybe Kevin Warsh is losing clutch over the body?
Well, I'm not concerned that there'll be too many dissents. You know, the Fed chairman is going to make sure, I think, that his direction, his particular leaning on this is going to carry the day. So yes, I would expect there are dissents. I wouldn't be concerned about that. We've heard those in some sense already being communicated publicly about how people feel about inflation. So I'm not terribly concerned that he will be outnumbered in terms of a direction today.
The characteristics we're seeing in this kind of oil price spike, is this something that the Federal Reserve could look through?
Well, they have been looking through it more or less, but we know that the oil price shock is a salient price. It can feed into other things. And so while this has been moving around, again, we haven't seen clear direction that we are getting an underlying disinflationary trend. Yes, we had cooler numbers in June, And I think that causes the committee then to really weigh more carefully what might the trend be? What is the direction going to be? And how much of that is influenced by oil right now?
We are seeing some companies come out, Reckitt Benckiser apparently coming out and saying because of the move in crude, they're going to have to put some of that into their products. Is that the time then where you would see the Federal Reserve start to really take notice of what's going on in the oil market?
Well, it is a factor that I think has been present for some time, and that is trying to understand the pricing power that is associated with any one of these particular shocks. And I do think that is always the risk that it broadens out. The Fed has been able to rely on anchored inflation expectations, but that is always a risk. How much time can pass before there begins to be questions about the Fed's commitment? And so that is always the tension here. How much time can you buy and keep inflation expectations well anchored as these various factors are unfolding?
Esther, instead of throwing bread rolls today, then, would you dissent?
Well, I wouldn't want to prejudge what information is coming out at that table, because you always learn something up until the time that you are voting on that interest rate. I have been concerned. I probably would put myself in the camp of thinking action is needed, that rates have not been restrictive as described in the past. So my leaning is to say inflation remains a problem, and the one instrument the Fed has to attack that is really its Fed funds rate.
Esther, it's always good to see you. Thank you. You were never the kind to throw bread rolls. Always welcoming, right? Always.
Wonderfully
Always.
So. Yeah.
The former Kansas City Fed President, Esther George, there on this Federal Reserve.
That's it. An expression, I imagine, does the trick for her. I'm sure she would look down and shake her head. Look, it's going to be a pretty robust discussion on the Federal Reserve, on the FOMC right now, because on one hand, you could argue they've had inflation above a certain level for a very long time. On the other hand, you could argue that a lot of these are one-time shocks and that some of the declines in the volatility that you're seeing in the tech sector are doing the work for them, that you're seeing some tightening in the policy rate. I don't know how much we're going to get clarity today, even with a press conference.
There is dissent in the ranks. And in that news conference, Chairman found it difficult to reflect the consensus of a divided committee. It's a hard task to do. I think for Kevin Warsh, it might be even more difficult. What I heard from Claudia Sahm earlier on this morning was to look for the statement. Look for the statement, because that's just about what they do agree on. And what they agree on right now wasn't a lot of text last time around. I don't anticipate it will be a lot of text this time around. I'll be going right to the bottom of that statement at 2 p.m. Eastern time to look for the dissent. I'll be surprised if Beth Hammack's name's not there, given that going into the blackout period, we had that statement from her on LinkedIn. And then I'm waiting for later. And by later, I don't mean 2:30 for the news conference. I don't mean later on that day. I mean the next several days once the quiet period ends and they come out and tell us what they really think. Because we've said repeatedly on this programme, Kevin Warsh, I think honourably, is trying to take this Federal Reserve into a new era. But his reluctance to provide guidance just opens the door for other people to fill the gap. And basically all you're doing right now is outsourcing guidance to everybody else. And this could be messy for some time to come.
I think it's going to be 125 words. I think it was 171 words.
Are we playing word guesses now?
I think that we need to.
We can do that later. I'm happy to do word guesses.
We
all
should
right.
definitely have a bingo card.
Give me a chance. Let me think about it.
Okay.
All right, come up with a number. We'll play some bets.
How about now?
Has Kaushi got something running on that?
I don't know. Get on it.
I'm sure they do.
I'm sure they do.
Third hour of Bloomberg Surveillance. Up next.
Tech is the future, but I think right now we're in an air pocket.
It's important to remember narrative follows price.
Anything that puts a dent on the perfection of the chip stocks will cause a market reaction. The mood is souring a little bit.
The fears of this gyrations in stocks, I think, will not slow down at all.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Keep it together, Bramo. Come on.
You're blaming me for this one.
No, I'm blaming you for that one.
All right, whatever. Moving right on.
Anne-Marie is too.
Okay. Oh, my gosh.
All right. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your equity market looks like this. Equity futures positive by 0.2% on the S&P 500. On the Nasdaq, up by a quarter. Heading into two big earning reports later on this afternoon. Here's your bond market, 2s, 10s and 30s. Yields just a little bit higher. 2s north of 430. 10s north of 460, yields up by 1 or 2 basis points this morning across the curve, heading into this later this afternoon, 2 p.m. Eastern Time. Fed Chair Kevin Warsh with his Federal Reserve decision. 30 minutes after that, a news conference with the man at the top.
Let's talk about the news conference. It's not necessarily a given that you always have a news conference after every Fed meeting, not under the Kevin Warsh Federal Reserve, but he announced that he was going to have a press conference, and he said previously he would only have a press conference when he had something to say. Can he afford to come out and have nothing to say at a press conference that he already put as optional, had the option of actually doing it, and now actually is getting before everybody? What does he have to tell us? One, his reaction function, and two, how he views both oil prices and AI-related inflation. If there are no indications of that, expect the volatility to continue in a sense that possibly the vacuum could be taken up by the other Fed officials.
And potentially has to come out and talk about the family fight. If we have dissents right there in black and white, he's going to have to come out and explain what the committee discussed and what was the arguments for those individuals that decided we don't want to hold rates, which they're likely to do, and actually we think there needs to be a hike.
So I've called it a divided Fed. It is, but I don't think the differences right now are that great. There were plenty of reasons to vote for a hike last time around. No one did. We've had a softer print CPI, softer PPI since then. Chris Waller, Fed governor, very outspoken, set the bar for his view, and inflation came in softer than expected. So what are we talking about here? We're talking about maybe someone says like 25, and everyone else says, OK, hold. What do I want from this? Tell us the range of views on the committee. Give us a decent idea of how you respond to the incoming information. I don't want guidance. I don't expect it. No one does. But we've moved on from that. I think most people in the press pack and the news conference have moved on from that too. We're not looking for guidance. We just want to understand your reaction function. How will you respond to incoming information? I think Waller did a decent job of that in his speech. He wasn't providing guidance either. He just said, OK, this is how I think about the decision. If the data does this, I'll do that. And if it doesn't, I'll do the other thing. And isn't that what the Federal Reserve should tell you? Isn't there some value in that? And if he doesn't want to provide that information, I'd ask a different question. What is the value of not providing that information? Why do you believe it's important to withhold that from markets, from individuals? What do you think the benefit of all that actually is?
I'm channeling Kevin Warsh right now.
No, please do.
OK. I'm waiting for the task forces to come back to deliver their conclusions before coming up with the appropriate reaction function for a modern Fed. How long can he buy time by saying task forces? And ultimately, that is what it has become. It has become buying time to give the market exactly that type of information. Forward guidance never was working at a certain point because the market didn't believe it. The market said, we're following the information, not necessarily what the Fed is saying. Forward guidance is different from a reaction function.
So we're task force dependent.
And that's what it was last time. Task force was the response to every single question.
Then what's the point of his job? Then just outsource the entire thing to the task force. He's the Fed chair. He has to come out and explain something.
I'm not that fired up about Kevin Warsh. I mean, I know other people are. I think everyone around this table are just, give him a chance and see what he does with this committee. But the reluctance to really talk about the economy, I just find slightly bizarre. I think it's kind of weird, strange.
Well, it partly reflects the fraught position he is in, because he was nominated and appointed to the Federal Reserve by this president to cut rates. We've heard that repeatedly. And he clearly is facing off with a Fed that has an inflation problem and that is completely divided. And as for his personal views, he previously was an incredibly hawkish individual who actually argued for rate hikes and for not using the balance sheet. So how do you square that Kevin Warsh with this Kevin Warsh, who is a task force beholden?
We could talk all day about this, but also
we will.
We will. Forget the president. We've demonstrated in the last 12 months that these guys at this institution aren't fireable, right? We've demonstrated that. We'll carry on pursuing it, but so far we've demonstrated that. In some ways, then, Kevin Warsh is basically untouchable. If they want to hike rates, they'll hike rates. I don't really put much weight on that right now at all. And for that matter, my opinion is not worth much. The market doesn't either. Based on market-based inflation expectations. It makes it even stranger with that in mind that he's not willing to talk about the economy much and how he thinks about things.
Maybe he sees ambiguity as a positive for him, that introduces a degree of volatility that tightens policy without having to move the Fed funds rate.
Yeah, give us a little bit of that.
Yeah, and give a sense of that.
What are the benefits?
Right, and that, I think, is a benefit.
We're burying that post-GFC hand-holding. I'm on board with that, whatever my opinion's worth. I'm on board with that. Let's get away from that. That's good.
A lot of people are.
OK, so what are the benefits of moving away from that? Just describe that a little bit more. And of course, people are going to be unhappy with this. I expect journalists to be unhappy with this. because they want more information. You were talking about this the other day. Yeah, sure. I expect economists on Wall Street to be unhappy with this as well. It's so much easier to do your job if someone tells you what they're going to do ahead of time, right? I expect everyone to complain about this, and we'll slowly get over it. But in the meantime, help yourself a little bit. Talk about the economy.
If he doesn't talk about the economy, I think people can accuse him of political interference that much more because you can attribute whatever motivations you want to what ultimately ends up happening. And clarity and transparency does end up creating the credibility of an organization that has been threatened by the lack of inflation stability, by the lack of inflation being closer to their 2% target for more than 5 years. So now is a question of how do you regain that in a different kind of way economically.
You've got this, Kev. 2:30.
You're hyping him up. You're hyping him up. I do know. I do know a lot of people at the Fed watch the show in the morning, and I feel like you're giving them a little bit of a hype. You're the hype man today.
Good morning, guys. Best of luck. All right. Coming up this hour, we'll catch up with Saira Malik of Nuveen ahead of a pivotal day on Wall Street. Luria of D.A. Davidson looking ahead to earnings from Meta and Microsoft. Plus, Haigh of Goldman Sachs saying markets can handle less guidance from the Federal Reserve. We begin this hour with stocks inching higher following 5 down days on the Nasdaq, heading into a big day for mega cap tech. Saira Malik of Nuveen looking ahead to big tech earnings, writing capex increases may lead to negative market reaction due to questions around ROI on $750 billion of expected hyperscaler spending this year. Saira, welcome to the programme. It's good to see you. Is there a sweet spot for capex and the way you communicate capex, given the experience of Alphabet just last week?
Well, it's unclear because the stocks have been reacting quite negatively to a very strong earnings seasons, and that's for 3 reasons. First is questions over the amount of money we're spending on artificial intelligence. Second is the Middle Eastern war, and third, of course, the Fed meeting. So looking at these AI stocks, the question is, can these companies come out and print higher spending on artificial intelligence without disappointing the markets? So far, not so good in that sense. You know, what we're watching for is are they going to talk about monetization of this spending and what kind of productivity returns that we're seeing on it? And that's really the question mark for the markets. Stocks down 5 days in a row, really poor returns in Korea for the past couple of nights. I think we're going to remain in a choppy market for tech stocks. If you look at the volumes yesterday, there were some signs of capitulation in terms of NASDAQ volumes versus the S&P 500, but we're likely still catching a falling knife here. What I'm watching for is some of these stocks that print earnings and actually get a positive reaction. We haven't seen that yet.
Saira, you talk about a choppy market. It's been choppy, but we're hanging in just a percentage point or 2 or 3 away from all-time highs. And it's been a kind of a rolling ball of money going from one sector to another, looking for the next hot trade. What would it take for the rolling ball of money to become a ball that's shrinking, people that are actually taking their chips out of the equity space?
Well, first of all, what we normally see is earnings and the stock market follow positive earnings growth. And this quarter is a great quarter for earnings. We're seeing over 25% earnings growth, 85% of companies beating earnings. All of that should be positive for the markets, but it's not. And that's mostly because people are not only worried about AI spending, but also the Middle Eastern war and oil prices. What does that mean for inflation going forward? And then everyone has been cautious for the last number of days because of this Fed meeting. Because we're not getting any forward guidance out of the Fed, or that's not likely, what we're going to have is more noise and less signal and a lot of uncertainty around the decision today. My view is that we do not get a hike today. We stay in the pause camp, and the Fed communication is going to be around what's happening with this five task force, and also that they're going to be depending on incoming data in terms of inflation. And with the Middle East war going on and volatility in oil prices, it's very uncertain in terms of where inflation is going to go from here.
And do you think that the lack of forward guidance, and not just forward guidance, but the lack of an understanding of the reaction function of the Federal Reserve has been responsible for some of the volatility and the chop that we're seeing in markets of late?
It's been responsible for a little bit of it, but I think that what's been overshadowing and taking all of the volatility and all of that volume is the AI and what's going on with earnings. People are very concerned that we spent, it's $750 billion on hyperscaler capex so far this year for all of 2026 likely. And are we going to see the return from that in terms of productivity and in terms of monetization of that artificial intelligence spending? That's the question mark. That's taking up a lot of the market volatility. And secondarily, the Middle Eastern war, the ceasefire, whether we have one, whether we don't, what that means for oil prices. And then thirdly, I think, is the Fed and whether we see a hike today or a pause. If we see a pause, we likely move forward with some volatility. If we see a hike, I think that'll be more negative for the markets.
Do investors need a resolution in the Middle East in order to remain bullish? What if we just live in this purgatory for the next 6 months?
I think that what we want, it would be a short-term positive for the markets if we get a resolution in the Middle East. But what we really need to see is continued strong earnings growth and a better market function reaction to those earnings, especially in the tech space. We came into this year positive on technology stocks, but at the middle of this year, we moved to a broader stance. We think the rest of this year is not going to be all about tech stocks. Broader market sectors are going to participate, like energy and material stock, where there's also strong earnings growth. The good news for markets is that when earnings grow at over 10%, markets tend to be up 10 out of 11 years. We are seeing that this year, but we are still up already 8.5% on the S&P 500 year to date. If you look at midterm years where we have midterm elections, for the 3 months before the midterm election, market returns tend to be zero. So we're in that phase right now. So I think first half was easy money. Second half is going to be more challenging money. Third quarter of the year may be the most challenging quarter of 2026.
Attempting to avoid the midterms, at least right now. Holding on to July, Sarah. Thank you. Sarah Malik there of Nuveen. I just know that we get closer to September and this becomes more and more of a thing, but trying to avoid it for now.
Yeah, well, we've got enough to handle. I mean, ultimately, We've got enough unknowns. It's sort of how many unknowns can you spin on your plate at one time? Too many. I'm sorry.
The tech will be part of the conversation too.
100%.
For the midterms, without a doubt. It's going to become a bigger and bigger issue. It is one already.
Absolutely. People don't want data centers in their backyard. People don't want electricity prices going up. People are concerned about AI potentially taking their jobs. I'll give you till after Labor Day.
After Labor Day?
You can hold on to the summer until then. After Labor Day, that's it.
I like stretching my summer deep into September, you know that.
I know you do that because of the weather, but I'm sorry.
You can't do Happy New
late
Year.
September?
September 7th.
6 days, but you got the summer.
Everyone
that
needs
lasts
rules, Bramo.
until November. Yeah, except by you. Come on.
Summer until the end of September. What's wrong with that? The weather's
September
great.
8th. I'm starting the show. Midterm countdown.
The weather's beautiful in New York in September.
It is. I'm just telling you what people are going to be talking about right after Labor Day.
Okay.
So I'm giving you
Shut
until
it
Labor
down.
Day.
You knew that was coming, didn't you? Shut it down. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. The U.S. military says it intercepted a so-called surprise Iranian ballistic missile attack on American bases in the Middle East. An Iranian state-run news agency says the Revolutionary Guard launched the missiles in response to recent U.S. aggression. More than 1,000 employees across leading AI firms signed a petition urging the U.S. government to support measures that could slow the pace of AI development. The letter warning that AI may be advancing faster than humans can control. Dr. Anthony Fauci is set to testify before the Senate Homeland Security Committee today on the origins of COVID-19 virus. The hearing comes after Senator Rand Paul released more than 1,100 pages of Fauci's private diary as part of his investigation into whether the virus leaked from a Chinese lab. And that's your Bloomberg brief. John.
Vonnie, thank you. Thanks for the update. I just can't relate to people who get excited about putting sweaters on. You know those people?
Yeah.
Gets to September and they're excited.
That's me.
You're excited for the sweater on? Are you really?
Pumpkin spice lattes.
100%. No, I don't do that.
But it's those people.
The basic. Those people.
I like seasons.
It's so weird.
So sue me. I like seasons. It's wonderful.
I like a nice boot.
Good to know.
Thanks.
Up next, the Morning Calls Plus, Luria of D.A. Davidson on why Microsoft earnings are the key report to watch this season. That conversation up next, live from New York City this morning. Good morning.
I think the right trade is not to trade. I think it's to hold your core positions. Some of the portfolio managers may just be taking some, quote unquote, time off until we get to the end of September, where we get a real seasonal uptick in tech. I think it's just time to take a deep breath and own the best names in the sectors.
Ted Mortonson of Baird, no time off, no days off, no breaks, no summer break at all. Just volatility in energy. I want to bring up crude, Brent and WTI, and you'll just notice they've ticked higher again. On Brent, on WTI, on Brent right now up close to 7%, closing it on 90. Just one simple headline from the president moments ago, speaking to an American broadcaster, enough to shift this market once again.
He said we'll be hitting Iran hard. This comes after an evening where the United States, alongside Saudi Arabia, went after Iranian-backed militias in Iraq.
This comes after you have the Iranians going after U.S. military forces in the region. And it comes as the Iranians are basically telling the Omanis, we're not playing ball. We're not going to sign up for a new deal when it comes to the Strait of Hormuz. And the president basically telling the market, we're going back to strikes.
You take that move in crude, you add a basis point to the sell-off in treasuries, yields higher by, let's call it 3 basis points now at 432. See that move in the bond market, 2s out to 30s. Push it through equities. Equities turn negative. They were positive, just like that. This is the issue right now. You're just not getting out of this, Bramo. It's just back and forth, back and forth. It's endless. Unfortunately, this is the uncomfortable new normal in the Middle East.
Touch grass, go for a walk. I mean, ultimately, how do you price this in? Because this type of volatility is something that is exhausting and yet not ignorable. And I think that's what we feel from a lot of different traders every day being whipsawed by this. At a certain point, the volatility begets its own price action, which is if this is the new normal, suddenly it will be that much more pernicious in a whole host of ways.
Equity futures slightly negative on the S&P 500. The open about 1 hour and 12 minutes away. Let's get you some morning calls. First up, Baird downgrading Caterpillar to neutral, citing government data center pushback as a headwind. The stock is down by 4.5%. Your second call from Wells Fargo, raising its price target on Snowflake to a street high, noting that investors are, quote, underappreciating its upside potential from AI. And finally, Bank of America reiterating its buy rating on Apple, saying its new leasing program may drive faster upgrades. That stock close to all-time highs, going into an earnings report a day away. The stock is up this morning by a tenth. Let's stick with tech. Earnings from Meta and Microsoft due after the closing bell. All eyes on plans for capital spending. Bloomberg's Ed Ludlow has more. Good morning, Ed.
Good morning, John. It's another CapEx test, particularly after Alphabet, but this time the market will want to see Microsoft and Meta justify growth in CapEx going forward. The key watch for Microsoft is its Azure cloud computing unit. Expectations are beyond 40% top-line growth. But if you think about where Microsoft will end its fiscal year, CapEx of around $147 billion in fiscal 26, the street expects them to tell us that CapEx will guide us towards a trajectory on CapEx that is $230 billion for the next fiscal year. So the dynamic now is that CapEx growth is far exceeding the current pace of top-line growth in the key cloud computing unit. Similar with Meta, 26% top-line growth. Capital expenditures for the year, $136 billion to $145 billion. If that number is sort of indicated to go much higher, well, where's the growth to keep up with it? And it's a simple calculus. We've gone from show us the spending to justify the spending.
Big 24 hours for Ed Ludlow and the team at Bloomberg Tech. Looking forward to the show, Ed. Thank you, buddy. Luria of D.A. Davidson staying bullish on Microsoft going into the results and writing Microsoft will be the key earnings report of the entire season. CapEx guidance for fiscal 27 will determine the direction of the market. Gil joins us now for more. Gil, key question then. Why is this the key one? Why this one name? Why is it so important?
For a couple of reasons. One, this is Microsoft's fiscal year end, so they're going to guide for 12 months for a full year, and they'll give us a hard number. So we'll be able to pin down how fast that CapEx growth, to Ed's point. Is it growing even faster than Azure, or is it growing slower than Azure will be the key question. And the other reason is Microsoft has been the responsible adult in the room around CapEx for the last couple of years. It was about a year and a half ago that when we were worried about the direction of AI, that they actually did step back CapEx a little bit. So that's why investors are looking to them to see if they're going to blink. They're more likely than Google, Amazon, Meta, et cetera, to blink. And that's why investors are trepidatious walking into this earning, is if Microsoft says they're reining in CapEx, that's going to be tough for the AI trade. We don't think they're going to say that.
Do you think that increasingly as CapEx has to go up, regardless of some of the pushback that you're seeing in capital markets, do you think that the better investment thesis is shifting to the bond space, to the credit space, and away from, say, buying the equity?
Well, to the extent that the bonds for these mighty companies, Amazon, Microsoft, and Google, are starting to trade at a discount, that does seem like a relatively safe bet here, because these companies are incredibly credit worthy and they all have the ability to stop CapEx on a dime. They could go to a fraction of their current run rate and still grow their business. They just believe, and they're trying to show us evidence that this investment is showing a return. But if at some point they decided it's not, they'll scale back CapEx and their cash flows will skyrocket. That's why these companies are more creditworthy than almost every country in the world. It's because their flow of cash is very reliable. It's almost like a global tax that these big companies have. Therefore, any discount to their debt is probably attractive.
Does it help them that you're seeing dislocation in some of the semiconductor names and pushback, potential competitive pressures coming from elsewhere when it comes to manufacturing some of the components?
It gives them a little bit more operating leverage vis-a-vis the chip companies. But realistically speaking, none of these companies is going to buy chips from China. And if that's the concern about competition, that's not that much of a leverage point against NVIDIA, Broadcom, Micron, et cetera. Those companies will continue to get the 75% gross margins as long as we continue to ramp the data center build out. But they'll certainly try.
Gil, it's good to see you. Looking forward to your reaction in the next 48 hours. Gil Luria of D.A. Davidson. It's Microsoft and Meta first, and then it's Apple and Amazon. We've learned a lot about price and positioning. We've repeated that over the last few weeks when you get great numbers from the likes of Intel and a stock sells off, or SK Hynix, phenomenal numbers and a stock sells off. You've learned something about how much that stock price has run and how well positioned people are for that. We've also learned a lot about leverage in places like South Korea. We've washed out a lot of that leverage with these massive swings, down more than 12% at the lows in today's session, up by more than 3% at the highs. That is a very wide range. That volatility prompted a meeting a little bit earlier on in South Korea at the finance ministry between officials, and they've just put out a statement just moments ago about curbing retail exposure to leveraged ETFs. That's been a major feature of the market in South Korea on the way up and certainly on the way down.
Yeah, they just put out a commentary after this meeting with the finance ministry, at the finance ministry, talking about how they are going to take more steps to stabilize their stock market. This has been a real point of concern, and you've put this well, John, when you say that they've been exporting volatility to the rest of the world. How much is that going to rein in some of the huge whipsaw swings that have really exceeded what we've seen in Bitcoin and bring people back to the market, convince them that these valuations are real versus just some sort of fiction of leveraged ETFs?
Typically, that would be the kind of headline in an emerging market that would be isolated to that emerging market. But that's a global headline this morning, given how much impact, how much input they've had on the stock story worldwide.
SK Hynix and Samsung are two of the biggest memory chip producers out there. They are the key input that have been increasing dramatically in terms of price for the hyperscalers that are trying to perpetuate the AI story. You put this together, they're very global companies, and this is a global issue.
And that's the latest on South Korea. Here's the latest in this market, turning negative on the S&P 500 just moments ago. Crude higher, Brent and WTI spiking higher off the back of a pretty punchy headline from the president promising to hit Iran hard and using some choice language to make that statement. More on that in just a moment. Stocks turning lower. We're down by about 0.1% on the S&P 500. We are negative by 0.2 on the Nasdaq this morning. The Nasdaq on a 5-day slide so far. Chips on a 4-day drop. 4 days of struggling chip prices, the longest streak we've seen so far this year. In the bond market, yields just a bit higher in the last 15 minutes or so, up 3 basis points. Twos, let's call this 431, 432, off the back of this move in crude. Crude up on Brent and on WTI by more than 7% now on Brent crude, $90 a barrel. Now, you'll often hear me say things like language matters. Language does matter. So I'm going to read you a headline that's dropped with regards to the president. And I'm going to just say that I'm paraphrasing here. The president says that he's going to hit Iran hard, but that's not the language he used. The headline, according to Fox News, which is who he spoke to earlier on this morning, was laced with profanity.
Right. And we've seen this president lean into profanity in the past, especially when he's frustrated. And he did so to Fox News, saying he's going to beat the effing something out of them, meaning the Iranian regime. It's AKA, a message is very clear right now to the market. We had strikes last night. It sounds like the president is leaning back into having strikes again after having a brief period of a pause.
Lisa, crude back in the 90s.
What do people do with these headlines?
What can you do?
I mean, it's one day to another, just whipsaw up, down, depending on the language, depending on potential strikes. that have occurred, you just wonder at what point the duration matters. We keep going back to that, but if we remain within this $90 to $100 a barrel range, because of this tit for tat, the new normal, as you called it, does that in and of itself create a new investing paradigm that the Fed has to consider and that a lot of investors do too?
That is the only assumption I can make this morning, Lisa. I've said earlier on this morning, we all have. I don't want to overweight the headlines about attacks. I also don't want to overweight the headlines about diplomacy either. Just observe that this is the new normal. It's an uncomfortable new normal. You're going to have days where there are talks and days when there are strikes. You're going to have days when there are unworkable proposals that come from the White House that won't last 24 hours, and we've seen that in the last month too. And you'll see Iran continuously testing the president's patience when there is relative calm, and we've seen that in the last 24 hours as well. But what does the new normal mean, the uncomfortable new normal for crude? It means you'll have days where energy is going through the Strait, traffic's starting to pick up, and days when it's not. And you're going to have an elevated price relative to what we would have otherwise had if we didn't have this situation. And it's not just the likes of the Middle East, it's also Russia now too, where crude product is becoming a bigger and bigger problem.
What's the bigger takeaway for overall economic trajectory going forward? Supply chains are going to be more prone to disruption, and there's going to be more volatility there. Raw material prices are going to remain elevated because of potential frictions within respect to how they get transported. And potentially, a lot of governments are going to have to pay a lot more to support their defense operations in order to prevent these types of things, which pressure the fiscal side of things. You put those pictures together, that's what everyone's grappling with, and the reason why borrowing costs are just inching a bit higher.
And the geopolitical risk premium's not going away, and you see Aramco potentially having to change some of their pricing that's going to Asia. You also see China stepping in, increasing some of their imports. You bring up a great point, what's going on in Russia, what's going on in terms of Ukraine hitting some vessels in the Caspian Sea. The problem we have now, and no one knows this, is when does it actually end? When is there a negotiation that's fruitful that actually ends this? And I don't see that happening with this regime before the midterm elections. So this is going to be the course, at minimum, I imagine, conventional thinking until November.
We should always be open-minded. Things can change. Just based on the experience of the last 5 months, things aren't changing anytime soon. We need to talk about South Korea as well. Wild swings on the Kospi once again. It's one of those markets now which is on the list, top 5 of the things you look at when you wake up in the morning. How does South Korea trade? And the Kospi was wild. It was down at the lows by more than 12%, up at the highs by more than 3%, and closed down 6%. And there is a concern now amongst South Korean officials, and I think we've seen that concern build and build and build more recently, about the amount of leverage building up in the system, the exposure of retail to that leverage. And officials met earlier on today at the finance ministry. They had that meeting and they put out a statement in the last 15 minutes or so, and they're looking to curb exposure to those leveraged exchange traded fund products that we've been talking about, and looking to cap their access to them with higher trading costs. Now, how quickly they can do that, what that looks like in practice, I don't know, but you can see that's becoming a bigger and bigger issue for them and everyone else.
If they take more steps to stabilize this market and they potentially curb the leverage used, does that mean that all of the leverage has already been washed out, or is there a lot more to go? In other words, how much more downside is there before there is more stability in this key market?
Hard to keep up this morning, isn't it? This is before we even get to the Federal Reserve and the earnings later on this afternoon.
How about this year? How about this month? How about this week? I mean, the week did not start today.
Can't wait to watch.
I was saying to a guest earlier on this morning, Q1 felt like a decade. Like, it really did. It just dragged and dragged and dragged. Then Q2 over, and Q3 is flying by as well. It's exhausting.
It is exhausting, which is a reason why when you bring up midterms,
I'm not there.
Are we really?
I'm not doing midterms.
I'm sorry.
I'm not even covering them. Just refuse.
Oh, really? Used to me.
Yeah, but you're extra innings.
Just shut it down.
Exactly.
I'll have no choice. As we count you down to the opening bell, 1 hour away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with the most actively traded stock in the U.S. in the pre-market this morning, and that is SoFi. Shares are down nearly 6%, even after the company posted solid results. It beat on earnings and member growth and even raised its full-year revenue outlook. Investors, though, are focusing on a few blemishes in the report, including higher than expected expenses. So just another sign of the high bar for earnings, and you get punished if you don't beat across the board. Meanwhile, not getting punished is Bloom Energy. Those shares up 8.8%. This is a company powering the AI build-out. It posted results and more than doubled its earnings estimates, raised its full-year outlook, and it's the third time this year the company increases its sales forecast, as it says that customers just keep coming in and arriving faster than ever. And if that's a sign of AI demand growing, Caterpillar and some sell-side action highlights one of the main risks, especially during an election year. I know you guys don't want to talk about midterms, but that is happening. Shares are falling nearly 5% after Baird downgraded the stock. They say that growing pushback against new data center construction could become a headwind for this company, especially in a key area that it's been banking on. John?
Yeah, Harry, you get a pass. You always get a pass. Thank you. We appreciate it. Counting you down to that Fed decision at 2 p.m. Eastern Time, this moment is different. We're not used to this. If your only experience of Wall Street is the post-GFC world, you're very, very used to the hand-holding. Typically, going into any decision, you know ahead of time what's going to happen. And if you don't, then make sure you know. This is different. Overwhelmingly, the consensus on Wall Street is no change of hold later on this afternoon. But there is an appreciation. There is a small risk they might do something different because we have a new Fed chair that is not willing to provide quite the same guidance. Mike McKee has more from Washington, D.C. Good morning, Mike.
Good morning, John. There's 19 members of the Open Market Committee, and 12 of them vote, but only one matters today, and that is the new chair, Kevin Warsh, what he thinks will probably carry the day. As you mentioned, the economist community is pretty much overwhelmingly convinced they will stay on hold, although Wall Street still gives it a 35% chance that they surprise us with an increase. Last time they did that, June of 2022, with that 75 basis point hike. There are no economic forecasts or dot plot today, so we'll all be listening for what Mr. Warsh has to say. Now, it's not unusual that he could surprise us. The history of new Fed chairs is that they tend to raise rates very quickly after taking office. Paul Volcker did it 2 months into his term. Actually, the only one of the last four who did not was Janet Yellen, who inherited us the middle of the great financial crisis recovery, and it took 22 months before they raised rates. But everybody else was willing to raise rates right at the beginning of their term. So the questions going into this afternoon are, will there be any dissents, and will the statement recognize any dissents? Last time, the statement didn't mention the individual votes, just the vote total. How will Warsh explain the decision? Either way, what will he say about what other members of the committee thought? What are he and his colleagues watching? This is maybe the most important question because it gets at the idea of what's their inflation framework, what's their reaction function, things that he has been reluctant to discuss. And that leaves us with the question of, will September be priced in post-meeting? It is priced in right now. Economists and market participants think that there is a better than 100% chance that we're going to see a rate increase on September 18th. The question is, where do we end up when the Warsh press conference is over? It is very different. And, of course, John, you have to shake your head when you see oil prices this morning, just when they started to go back down, and maybe help Warsh make the case for keeping rates unchanged. Here we go again.
Of course, we don't know where it's going to be 5 hours from now, either, for that matter, Mike. It is a change. Can I just ask you, as a journalist who's in that room and has sat in front of central bank chief after central bank chief over the last several decades, Mike, how your approach is going to change to the kind of questions that you ask this Fed chair? No one wants to be on the receiving end of a two-word answer or any answer that involves task force. How is your approach different to this moment too, Mike?
Well, I think we're going to be looking for people to ask specific questions about specific thoughts as opposed to more general questions along the lines of what is your reaction function, because that could be easily parried. But how he looks at the oil price increases that we've seen recently, does he think they're inflationary, or is it time to look through them? And what is it that he thinks the task forces should accomplish? When you look at the Wall Street Journal story from yesterday, the anecdote about Chris Waller saying it's not like anybody hasn't thought of this stuff before. What does he think of that?
Can read it out to him, Mike. Looking forward to it. Michael McKee, with the latest down in Washington, D.C. Stephen Stanley of Santander expecting the Fed to hold rates today, but hike twice later this year, writing the Fed has entered a brave new world. It's been many years since there's been this degree of uncertainty about whether the Fed would change policy or not in the lead up to a meeting. Stephen joins us now for more. Stephen, good morning.
Good morning.
Is it a welcome change?
I think it is. It gives the Fed flexibility. The complaint that Warsh has had is that basically the Fed would lock itself in with forward guidance. So I think, I think back to, okay, what would this period be like if we still had kind of the old regime in place? And I think my guess is they would have been kind of looking toward a September rate hike, and they would have already started to signal that in June. So they would essentially already be kind of locked in. Well, what if things change, right? What if the inflation numbers are all of a sudden, we got the softer June CPI, what if you get a string of those? They've already kind of locked in for September move. That's why I think Warsh wants to invoke more uncertainty to allow the Fed to have flexibility.
Why is it valuable to hike in September and not now? Why is there so much value, in your view, to sequencing things in that way?
Yeah, well, I think this is an example where you can make a strong case in either direction. So I'll make the case for holding off. As I mentioned, the last inflation reading that we have in our hand is the June CPI, much softer than expected. So is that a one-off? Is that a fluke? Or is it the beginning of a trend? Is something moving around with regard to inflation? I think there's specific reasons why we would learn a lot by getting 2 more rounds of monthly data, which we'll get between the July and September meetings. One, we're still trying to figure out where we are with regard to tariff pass-through. Fed keeps telling us we're toward the end of it, and there's evidence of that, but we're not quite sure. Secondly, and I think more importantly, we're really in the early stages or maybe the midst of energy price pass-through. So we've seen energy prices go up, we've seen airfares go up, all the obvious stuff, but you haven't seen it bleeding into everything else. You haven't seen food prices go up on the back of transportation costs. You haven't seen firms raising their prices because their energy costs are higher. Does that mean that's not coming, or does it mean we just haven't seen it yet? Again, 2 more months maybe gives you some insight into that.
Do you think that the Fed has any responsibility for why inflation has remained above its target rate over the past, not only just 5 years, but in particular in the past year and a half?
Absolutely. I'm a big believer in what Warsh says. The Fed controls inflation ultimately, and they have the tools to bring it back to 2%. And they haven't done so.
So what do you make of people who argue that ultimately this is one-time supply shocks and that's the reason why they've been facing this? It has nothing to do with monetary policy, and it wasn't in their control anyway because this seems like a more rate-insensitive economy.
So my response to that would be, and I think I'm going to be channeling the chairman a little bit here, so the Fed controls the amount of liquidity in the economy. So if we think about an energy price shock, for example, if energy prices go up, gasoline prices go up, the Fed doesn't have control over that. But if the Fed injects liquidity to offset that so that consumers are made whole, then the overall inflation rate will go up. If the Fed doesn't, then household budgets will get squeezed, the demand for other things will go down, and other prices will have to go down while gasoline prices go up. The overall inflation level stays the same. So this goes all the way back to the 70s. It's this issue of, do you accommodate an energy price shock or don't you? And in essence, what I would argue is that the Fed, you can say, well, this wasn't really our doing, supply shocks and energy prices and all the rest, and that's fair enough. But policy at the end of the day has been too easy, and that's why inflation has stayed high and hasn't come down.
That will be part of the debate later on this afternoon, no doubt, in that news conference. Stephen, thank you, sir. Stephen Stanley there of Santander. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump says the U.S. will hit Iran hard after a recent attack that targeted a base in Jordan. In an interview with Fox News, the president saying, quote, they're going to get a beating. Trump's comments sending oil to session highs. More than 1,000 employees across leading AI firms signed a petition urging U.S. government to support measures that could slow the pace of AI development. The letter warns AI may be advancing faster than humans can control. A massive new data center coming to Kentucky. Brookfield and NextEra Energy are teaming up on a more than $100 billion project that will turn a former uranium enrichment facility into a 2-gigawatt data center campus. It's expected to create 8,000 construction jobs and 600 permanent positions. That's your Bloomberg Brief. John.
Bonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. What a 24 hours we've got coming up. Plus, we'll touch base with Haigh of Goldman Sachs, saying markets can adjust to a new regime.
The bar is set too high for any stock associated with the AI trade, right? And it's not to say that the underlying fundamental story is not good, but the bar is just being set too high. The new beat is, call it a 10% beat on earnings and a lower CapEx guidance. I think that's the thing that's going to get stocks to rally.
That right there is the sweet spot, according to Dan Suzuki of iCapital, heading into those earnings later on this afternoon from Meta and Microsoft. In the market right now, stocks and bonds a little changed ahead of this afternoon's Fed decision. Haigh, global head of fixed income at Goldman Sachs Asset Management, writing, more important than the decision itself might be the messaging. Markets can tolerate less forward guidance, but they struggle when the policy framework itself is unclear. Haigh joins us now for more. Haigh, good morning. Good to see you.
Good morning.
How unclear is that framework this morning?
Well, we're going to find out. I mean, the market tells you something. The pricing of 30% is a kind of unusual pricing going into a Fed meeting. By now, you would have thought the market had settled. So it gives you an indication of what the market is looking for, and that is a little bit more clarity around the reaction function.
2-year yields right now, yep. And for the last several months trading comfortably above the policy rate.
Yeah.
When you look at that, I think framing matters here too. Do you see that as a bet on hikes or the risk of hikes baked into the yield curve?
Good question. So I think the first point is it's important not to confuse a lack of forward guidance with there being less clarity about the reaction function of the Fed. So hopefully the reaction function, we're going to get more clarity as the day goes on, and that would be great. The market would like it. The second point is, look, the statement at the last meeting, the focus on inflation, really dampened a little bit the volatility at the longer end of the curve and moved the volatility down the yield structure. So you're going to get more volatility at the short end. That's consistent with a focus on inflation, with being data dependent and less forward guidance.
If you get a hold that isn't as hawkish as people expect, do you think that reintroduces volatility to the long end of the yield curve?
It depends how it's framed, right? So, when you say not as hawkish as people expect.
In a sense.
Yeah. I think that would introduce a little bit more uncertainty around the longer end of the curve. But look, we've got another meeting in September. The market right now prices a hike, and I think, that volatility is probably short-lived because the market will look towards that meeting very, very quickly.
Why do you think we don't have more information about the reaction function of this Federal Reserve?
Well, because it does look at first sight that there's going to be some changes, right? We've got the task forces. We had the communication. The market is trying to figure out what a new kind of governor is going to bring to the table. So it's not unusual that the market is trying to wait and see and look what it can glean from communication today.
Haigh, you said something important about bringing volatility in. Bring it to the front end of the curve and it dampening yields at the long end of the curve. It makes me think whether this is all by design. Do you think it is by design? Is that the objective here?
Well, good question. Like, design for what, right? I mean, your question might refer to the fact that it's by design to kind of cheapen the long end a little bit. Maybe that's it. But I think it's consistent with a data-dependent Fed, and I think it's consistent with a Fed that's going to be less focused on forward guidance. So the market then has to figure things out. And we've come out of a very unusual period, right? That's another thing to kind of keep in mind. Like, what's our base here? Our base is really a kind of post-QE. We've been used to there being a lot of clarity. We've been used to having Fed meetings that were well advertised. That's a recent phenomenon. If you look at what the world looks like pre-08, that was very different. This goes back to that kind of environment.
What are the investment implications with that shift? Leaving behind the post-GFC communication architecture, we're leaving that behind. The hand-holding's over. What does that mean for investing?
I think it puts the focus squarely back on understanding, the underlying trends in the economy, what's happening to inflation, what's happening to growth, what's happening to the propagation mechanism. You're going to get much more differentiation between different central banks as well, right? Not everybody is going to be doing a very similar thing. So this week we've got Bank of England, we've got Bank of Japan, and we expect very different communication from them. So what are the implications? Look, macro matters more, fundamentals matter more, data matters more, and you're going to get way more differentiation in markets.
Does that mean that you have different outlooks when you look across DM sovereign bonds right now? Can you give us an idea of where you're constructive and where you're less so?
So, yes, it does mean we have different outlooks. We'd probably be much less constructive in terms of kind of yields going down in places like Japan. I think you're going to look at the UK and you're going to be a little bit more kind of data dependent, and you will see that kind of differentiation. That's at the short end. Then add onto that the long end implication, right? So there's issuance at the long end. There's kind of pressure of coming from fiscal in places like continental Europe. So absolutely much more differentiation.
So much has changed in fixed income. The communication shifting markedly at central banks like the Federal Reserve. Forward guidance is over. Then you've been dependent on the other anchors in fixed income going away too. So you could have been dependent on fiscal prudence in Germany, that's over. In Japan, disinflation, that's done. Now got inflation. Everything's changing in fixed income in the space of a couple of years.
The era of financial repression is over.
Big time.
And guess what? There's yield and there's uncertainty. And for a debt investor, actually, this is pretty great, especially if you don't have hyperscalers sucking all the oxygen out of the room, because suddenly you're getting leverage and you're getting yield. People said that bond vigilantes were dead. They are alive and kicking, and frankly, they're out there capitalizing on that. And that's what you see in terms of yields at some of the highest levels that we've seen going back years.
Talking about Kai, is it a good moment to be in the bond market?
It's very exciting. I mean, look at today. We're all talking about the Fed. That hasn't happened in a long time. So.
It's been boring for a while, hasn't it? Kai Haigh there of Goldman Sachs. Kai, it's good to see you.
Thank you.
Thank you for being here. Appreciate it. It's just a massive shift. I think we've all stated that going into this Fed decision. Yeah, at 2 p.m. Eastern time, I might sit here and say unchanged, couple of dissents, and it might sound boring. But just the very fact that you don't know, and there's this small margin of risk, and that small margin of risk is now in the market pricing as well, is a different world.
It's something of a mystery why inflation has been so far above the Fed's target for more than 5 years and why it has persisted. People can make their arguments. Going forward, it really sets up a new trajectory for this Fed.
Surprise appearance later?
No, I'm gonna be watching with popcorn, with bated breath. Can't wait to see you guys do extra innings.
Okay. Maybe we'll dial you in. Maybe.
We'll put a little figurine
Maybe.
here.
Special programming, 1:30 Eastern time. On Bloomberg Surveillance, the Fed decides. From New York City this morning, good morning. Looking forward to covering the Fed with you later on this afternoon. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.